Okay, so a very good morning to all of you, and it's really nice seeing all of you. A very warm welcome to all our face-to-face live as well as recorded students who would watch. Really happy to be with all of you, and we'll start with the first paper. Okay, so this is financial reporting, and it's one of the most exhaustive and undoubtedly the biggest paper of your CA final syllabus. So till now you have just been doing, if you say bookkeeping, say we reached up to accounting, then we went to advanced accounting, and now we kind of culminate into what is the most important essence of your accounting understanding, which is what you call as financial reporting. So how will what you account actually get reflected in the financial statements? And that is the base, that is the essence where even if you want to make a career in the world of finance, almost every financial investor would look at the financial statements for an analysis of the company's performance. So this is your starting point when it comes to even financial accounting as well as financial analysis. You go to equity research, you go to investment banking, you go anywhere, you will have to look at the accounting, not necessarily accounting, but the reporting, the reports of the company to gauge how the company is performing. So it's a very interesting, very important subject, and in terms of the coverage, it's as good as two subjects into one. So it is a much more bigger subject, and I'm pretty sure we'll have a very good time. We'll understand it to the depth. We'll not just remember the accounting treatment, we'll more so try to understand why a particular treatment happens and try to have a deeper understanding. Okay, so when we are going into the new syllabus now, so your paper pattern slightly differs. Historically, this has been one of the most difficult papers to complete. The paper as such is fairly standardized. However, it was one of the most difficult papers to complete because it comes in as paper number 1, and because it is paper number 1, we are very conscious. We do double lines, we make boxes. By the time we realize that half the paper is over, right? So it's historically been a slightly difficult paper to complete, and it has been a paper where students usually would find it a little hello, yes. So this has been kind of a paper where students have had slight difficulty in completing. Truth be told, I completed only 78 marks of my paper when I wrote the exam. So I have some bruises still on that, but I'm pretty sure that you should try to time yourself better, and with MCQs coming in, it should be a fairly more manageable paper to kind of complete. Okay, so we'll get started. I'll just run you through the paper, run you through what is overall the coverage, what is more important, and everything. Okay, so a quick background about myself also. I'm Bhavik, and I've been teaching FR and AFM for slightly more than a decade. So earlier FM, now SFM, now AFM. It has gone into a lot of changes in names, and I've been earlier I was working with Morgan Stanley and then JM Financial in their investment banking teams, but nevertheless I used to love teaching from a very early age. So I've taught people from the 3rd standard all the way up to CFA level 3, the 3rd standard being the most difficult to teach. Right? Okay, so I've been teaching since fairly early age, and that's where I've landed. So I'm really happy that I get a chance to teach you guys, and I hope I get to do some justice as well while delivering this wonderful course. Okay, so let's kind of run you through the index. Yes, please. So it's a fairly small index. As you can see, there's close to 30-35 topics, and in terms of coverage, we'll try to see what is usually frequently asked. But having said that, now the dynamics would slightly change with MCQs. So when we look at our paper now, our paper would have 30 marks of MCQ. That is a separate paper, okay, where you have an OMR sheet and you will write, and there is a 70 mark descriptive. So when you look at the descriptive paper, your descriptive paper would be made up of 14 into 5. So that is 70 marks with one option. So there will be 5 questions that you will have to attempt, each question being 14 marks at max. Typically that will be broken down. Just a consolidation question or the business combination question will be a full 14 mark question. Other than that, every question will have subparts, maybe 6 plus 8 or maybe 6, 6, 2, whatever it is, but it is largely going to be just one question which will have the full 14 mark coverage. Question 1 goes in as compulsory, and among the remaining 5 questions you have to attempt any 4. So that ways you'll have one question as an option. Otherwise, so there'll be 6 questions in total, out of which you'll have to attempt 5. Then comes the MCQs. MCQs, they have not really been tested at financial reporting earlier. This is the first time you're going to sit for an MCQ. But if we kind of take a base, we do expect that this will be broken up between the individual MCQs, which will be around, in my opinion, not more than around 12 to 15 marks. And then there would be case-based MCQs. Like you have a case, and below the case you will have around 4 or 5 questions. So there will be case-based MCQs, which will be around another 15 to 18 marks. A higher weightage will generally go towards the case-based MCQs. Within the individual MCQs, from what we understand from papers like DT etc., where MCQs were earlier there, the 1 mark MCQ is the typically easier one, the 2 mark MCQ is a difficult one. Case-based MCQs are a mixed bag in general. So currently, earlier we used to do a very standard ABC analysis. Now that would generally, in my opinion, not stand, because usually the ABC for an MCQ is different from the ABC of your main descriptive paper. Like in a descriptive paper, consolidation is very important, but then you don't really expect a consolidation question when it comes to an MCQ. A very smaller, like in your CA Inter, you might have something like events occurring after balance sheet date. Remember? Yes, okay. So that is not really important, but for an MCQ it's a classic case. Adjusting, non-adjusting, this, that, it's a very classic MCQ case. So that ways, with MCQs we would expect a much more balanced weightage now, which is very welcome. Rather than just a skewed weightage towards a few chapters, you will have a much more balanced weightage. So when we look at your overall topic, generally, okay, and I do believe that a large part of it would still continue, generally the most important topic is, so if I look at my overall coverage, undoubtedly the most important topic would be the chapter on financial instruments. Now before we start, how many of you are doing your articleship in audit? Acha, majority. Have you guys audited Ind AS balance sheets? Yes, so few of you would have, but majority of you maybe not. How many of you are doing articleship? Everyone is doing articleship, right? Okay, chalo. So we have coverage. So majority audit, fair enough. So when you look at coverage, maybe if you have done Ind AS balance sheet, even if you have not done, no problem, we'll kind of run you through a few company balance sheets as well while we are kind of reviewing, so that you get a better practical perspective. So the most important topic, and if I say that something is the heart of Ind AS, that's financial instruments. Covered between Ind AS 32, 107, 109 on an average in your main exam earlier, and still I would easily say this would go anywhere between 12 to sometimes 18 marks, but maybe on an average, let's say you put anywhere between 12 to 15 marks. Minimum 2 questions in your descriptive paper. Every time you open and you will see at least 2 financial instruments questions. I'm pretty sure this will come in your descriptive, continue to come in your descriptive and your MCQs. It's made for both of them. So it's a very important chapter, the heart of Ind AS, undoubtedly. Next you go to consolidation and business combination. In your CA Inter, you have done consolidation. That was an AS based consolidation. Now you have the Ind AS based consolidation. Earlier you had amalgamation. Now you have business combination. So they are 2 different topics on their own right, but I would say consolidation and business combination put together would have around 20 to 25 marks weightage. So in general, how things go is there's one big question from one of the 2 topics. So you don't have 2 full schedule 3 balance sheets coming in your exam, you'll have one full question from one of the two, and for the other you'll have smaller question. Like if you remember in your CA Inter you had to calculate purchase consideration, so you'll have a smaller question, chalo calculate purchase consideration, calculate goodwill, that's it. So you will have probably a mixture of a 14 mark question and a 6 mark question typically, or two small 6 mark questions. So that's around 20 to 25 marks, you can say maximum 25 marks. Again, both of these topics in my opinion are largely made for the descriptive section rather than the MCQ section. Financial instruments is kind of made for both, but here consolidation almost entirely will come from the descriptive side. Business combination might have a bit of mix of descriptive as well as MCQs. Okay, next when you go to the important weightage, you have Ind AS, the two youngest Ind ASs. Anyone is aware? The two most recent Ind AS? No? We don't even know what Ind AS is probably? We know? Yes, we do know. The two most recent Ind ASs would be Ind AS 115 and Ind AS 116. 115 being the standard on revenue, 116 being the standard on lease. So till the time 117 comes, we should be out of our course hopefully, but 117 is in the works. There's a standard on insurance, Ind AS 117. It is still not applicable, and we pray that before it becomes applicable we kind of clear this course. Okay, so but that's so 117, if and when it comes, will have zero impact on the other standards. So don't kind of freak out, what we are studying, is it redundant? No, it's a specialized standard on insurance. So if I'm an insurance company like LIC, how will I apply it? That's it. For other companies it does not really matter, so it is not going to have impact per se, even if it comes, and if it comes we'll obviously be sharing the amendments, but till that time 115 and 116 you'll almost certainly get a question on this, each of these in the exam. And if you ask any of the students who have cleared, it's almost certainly an interview question. So 115 revenue is the best that almost every interviewer uses for checking the overall understanding of a candidate. Earlier you had a cute little AS9. Now that AS9 has expanded dramatically. I mean, in your study material it's more than 150 sides for just 115. Cute little AS9. Okay, so that is on revenue recognition. And then leases. So in leases, in your CA Inter you studied finance lease, operating lease. A lot of headache. Finance lease, operating lease is abolished under 116. There's no concept of finance lease, no concept of operating lease. There's something else now. Institute keeps you on your toes almost always. So you'll have 115 and 16, both of them together. I mean, typically around 15 odd marks, 8 to 10 from one, 8 to 10 from the other. So around 12 to 15 marks. Almost certain weightage will come from revenue and leases. Next you go to share-based payments. Share-based payments. Now, can you think of an example of a share-based payment? ESOPs. A classic example of a share-based payment would be an ESOP. Now, ESOP is, in my opinion, out of all of these very important topics, it's the easiest one. So, the typical weightage around 6 marks, you do get a question of around 6 marks from the share-based payment chapter. I would now kind of put a slightly more weight behind ESOP. Most of you might have cleared under the older syllabus, right? So, earlier you have studied ESOP, but now in the new syllabus of CA Inter, ESOP is no longer there. ESOP is removed, so that is why it has a much more higher testing probability at final CA. Earlier you had CA Inter, CA final, so people would, institute would not really test you extensively. Probably a question, but I would definitely now think that ESOP is coming in your exam because it's now removed from CA Inter. The only opportunity they have to test you is at CA final. So ESOP is definitely an important topic. And then there are two new topics which have been added. These are core theory topics, two new theory topics. One is accounting and technology. They've added some fancy terms like blockchain, artificial intelligence, but nothing more than 2 paragraphs. So we'll try to understand it at a little length, but right now it's just kind of scratching the surface. There's technology, and with all that is happening around you, ethics has been included because we need very talented chartered accountants like you who are ethical as well. So ethics has been added. In my opinion, this will be a pure theory question. but probably around 4 to 6 marks, certainly with more emphasis coming on the ethics side. Maybe if technology comes, then it will come more like an MCQ in my opinion, because they'll just give you a feature and say that this is a feature of what, blockchain, artificial intelligence, ERP, automation, what is this? So they'll not ask you a full-fledged question in my understanding, but ethics is something where they'll give you a case and you will have to apply your moral science and say that whether this was an ethical thing or not. So around 4 to probably 6 marks, maybe even more, but not more than 8 marks for sure. So that is regarding technology and ethics. Now, if I remove this part, so if you look at your shield on your index, it is a part which starts from topic number 25 and goes on up to topic number 33. This is that part. This is around 50 marks of your syllabus, 50% I would say, not even 50 marks. So your total exam comes of 114 marks, one being optional. So when I do the overall weightage, it's 114 marks, MCQs you don't have a choice. So over here, out of the 114 odd marks, earlier 120 marks, this section starting topic number 25 to topic number 33 will at least account for 50% of your overall marks if you just total up. So we'll say, chalo, we'll study this much only. But that is apparently it just appears to be 8 or 9 topics. But if you look at the volume, it's 50% of your overall material. I mean, the number of sums, almost every topic over here has close to 80 to 90 sums. So it's as big in terms of your overall weightage. So sir, what about everything else? Well, all other indices. All other indices which go from topic number 1 to topic number 25, all other indices will account for the balance. So if I go to see approximately, I mean, I'm not very sure about this, but 12, I think around 50-60 should be the case. 12, 6 and 4, yes, so approximately 60 odd marks, 60 to 70 marks, if I'm not wrong, would come from all the other indices, where you have small questions but much more scoring ones, because they are relatively easier. There's a small topic, does not have much of complexities, small question, MCQs, and this is fairly scoring. Do everything, and this is one of the very few papers, or rather the only paper, where you don't have to worry about the last 1.5 days preparation. So AFM is smaller than FR, significantly smaller than FR, but people struggle to complete it on the last day because they just have 1.5 days. FR, typically every student starts 4 to 5 days before their main exams, and as a result you are able to complete everything. The last corner of your syllabus you are able to complete, and that's why I would definitely not recommend you doing a selective approach. You should do the comprehensive approach, cover everything, and you should, this is probably for almost, for most of you at least, this is the last time you are studying. I mean, what have we been doing since childhood, right? We are studying only, right? This is probably our climax, so might as well do it the best way, right? So do a detailed understanding. You have fairly heavy books with you today, so try to cover almost everything, and I think you should be good. You do not, I mean, almost everything of the study material, of the RTPs, mock test papers, revisionary test papers, everything which is relevant is shared even after your batch gets over. And if there are new RTPs, etc., we typically share it on YouTube directly. Otherwise, on your Google Drive, you will have access to that as well. So, but you have to study, right? Okay, that is the most important thing. So that is about it. Are we in a good position to start now? Any problems? Any questions? No? Chalo. So let's get started. We'll first start today with introduction to Indes. Earlier this was not a separate topic, this was not a separate chapter, it was just a broad introduction. In the new syllabus that comes with effect from May 24, this has been added as a separate topic. So we'll discuss what is Indes as a first thing, why did we need Indes in the first place, and to whom is Indes applicable. Okay. So in your CA Inter, what have you studied? What have you studied? Which accounting framework have you studied? Yes, accounting standards. Okay, we have studied accounting standards. So accounting standards was formulated and devised by whom? By our beloved ICAI. Now, what is the problem in that? What is the problem in accounting standards, and why do we need, that's right, why do we need Ind AS in the first place? Now, when, let us say, just going off track, let us say we have kind of manifested and we have seen ourselves probably clearing CA, and probably we'll go out to travel. So typically, what are your what is a typical dream destination for a typical Indian person? Where do typical Indians go? Oh, US, one of the best places. Anything else? UK. We have colorful people as well in the batch. We want to go to Bangkok, Phuket, great. So most of these, okay, you have US, UK, Australia, blah blah blah. So the typical things. Now, what is the thing? I mean, do a lot of people go to Japan? I mean, people have started, but not as many. Japan, Korea, etc. The south one. Most of the people don't go there. Why? There's an inherent language barrier, right? We would say that, okay, we are strict vegetarians. I don't know what I'll end up eating. I don't know what's written in the menu. Might as well, if I have to even go for a 1 or 2 week holiday, I would resist going into a country which the language of which I don't understand. Now there are a lot of investors, international ones, who want to invest in India. Now they have studied IFRS, International Financial Reporting Standards, which are applicable in close to 120 countries across the world. Almost every major course, whether it is CFA, ACCA, everywhere you have been taught about the IFRS. Now the problem is, if that investor wants to invest probably hundreds and thousands of crores into an Indian company, they want to understand what the Indian financial statement speaks. Now the Indian financial statement is written in accounting standards. Now you know accounting standards, I know accounting standards, an international investor does not. And that is why they would say it is a natural put off. They would say, Chhod na yaar, I don't know what is written inside. If I don't know what is written inside, might as well invest in a country whose language, a company whose language I know. The language of the financial statements is the accounting standards. You might think that, okay, this is there in the accounting standard. International investor does not know. He does not know how the net profit is calculated, whether it is calculated after making appropriate adjustments or not. And that is why, if I want bigger foreign investment in my country, I want to speak the language of the international community. And that is why ideally I should adopt IFRS, and that is why the movement from AS to Ind AS, because if I want to get foreign investors on board, my financial statements has to speak the language that a foreign investor understands, and a foreign investor typically understands the language of IFRS typically, right? So that is why we want to move towards IFRS. What is IFRS? International Financial Reporting Standards. By whom is it issued? Someone called as IASB, International Accounting Standards Board, which is domiciled in UK. Now, the problem over here, ideally, then why are we studying Ind AS? We should be studying IFRS. Why are we studying Ind AS then? How does Ind AS come into the picture? Ideally, we should go to IFRS. Now, the problem over here is IFRS is developed by someone who is a developed country. I mean, they have problems which are different than what a developing country has. So probably there are certain things which we don't agree with in IFRS, but by and large, I want to converge with IFRS. So currently, IFRS and AS would have more than, without exaggeration, more than 450 to 500 individual differences. IFRS and accounting standards. So I should have gone to IFRS, but IFRS has certain treatments like in your CA Inter, remember you studied about escalation? Escalation is increase in price. Now escalation is a reality in developing countries like India, because our inflation is relatively high. But if you go to US, UK, etc., at least over the longer period, udhar hardly 0.5% ka inflation is there. Abhi you will kind of feel shameful to add a 0.5% escalation clause. What is 0.5%? It is almost nothing. So escalation, etc., are not as big a realities in developed countries as in developing. So you don't have enough lease escalation adjustments there, or there are a lot of treatments that they don't agree with. Like for example, in your CA Inter, you remember you have PC minus net assets, purchase consideration minus net assets. Where does it go? Goodwill. If the purchase consideration is 100, net assets is 80, we would say that, okay, 20 rupees is the excess that I paid on account of goodwill. But if it is the other way around, if the purchase consideration is, for example, 80 rupees and 100 rupees is the net assets, why? No, a lot of things are one time. Like you sell a plot of land, that's a one time sale. You don't sell it every time. Why does that go into the profit and loss account? Probably not. In my opinion, it goes to the capital reserve largely because it is a profit on purchase. Everything else that you have studied across your syllabus is a profit on sale. It's a realized profit. When you sell a land, when you sell a machinery, that is when you earn a profit. It goes into the profit and loss account. It's a realized profit. When I purchase a business, I'm booking a profit on purchase. I'm not selling anything. I'm purchasing something. Okay. When I go to buy this bottle, for example, this bottle is 100 rupees. I buy this at 20. I buy this at 80. I don't record a 20 rupee profit. I say, okay, the cost of this bottle is 80. It's not 100. But that does not mean I record a profit of 20. Now, this is a very unique transaction where we are saying, we are buying something here. We are buying something and we are recording profit. Okay. So we take a step back. We come to prudence and conservatism and we say, no, this can't be a part of P&L account. It's a profit on purchase. And hence we have, as Indian, so we have to reset our alarms. Okay, so going forward from tomorrow. So as Indian regulators, we were of a very clear view that a profit on purchase cannot go to the P&L account. Now internationally, IFRS is of the view, well, they say that okay, let it go to the profit and loss account. So if you open an IFRS commentary, they would say that this difference, if positive, I've struck a bargain. They call it as bargain purchase. We have purchased it at a cheaper price, let it go to the P&L account. We don't agree with that treatment. And hence we have done what we call as a carve out. Carve out, samajhte? There is an IFRS framework. We are carving out something that we don't agree and putting in something that we want. There are exactly 14 places of differences, 1-4. Which the institute has released as a booklet, and they have said, well, you know what, these are the exact 14 places where IFRS and Ind AS differ. Otherwise, you have studied IFRS, you refer these 14 areas of differences, you know the Ind AS. So because there are certain treatments where we fundamentally disagree, and as a result we said, no, we don't want IFRS, we'll converge to IFRS, but we don't adopt IFRS, and hence these standards are called as Ind AS. So we have moved up. Do we have the background? We moved out of AS because we want international investors. So ideally we should adopt IFRS. But IFRS has certain treatments which we fundamentally don't agree with. Whatever be the reasons, we'll come to each of those treatments. So over here, when we study, IFRS is not applicable for your syllabus, but nevertheless, for an overall understanding, when we reach specific places at each topics, I'll tell you that these are the differences between IFRS and Ind AS. So that way, we will know what IFRS is. There's zero difference beyond that, zero. So a person who wants to understand IFRS does not need any separate training. He just has to sit for around a day, just refer those 14 areas of differences and you are on speed. So that is why we have named it as Ind AS. That is why we have named it as Ind AS. Are we clear with this? Acha. Now when we look at the numbering, AS had a very logical numbering. 1, 2, 3, 4, 5, 6 I think was not there, 7, 8, 9, 8 is also not there, right? So, but otherwise it's a chronological numbering. If you look at Ind AS on the other hand, you'll have 1, 2, things are going smooth till now. Then you go to 7 directly, 8, 10, 12. So the numbering is a little illogical. The moment it comes to 41, we directly jump to 101. So the numbering over here, why is it I mean, you remember essays that you have studied in audit? Kuch bhi number. So there is no logical sequence in that number. Even over here, you will have numbers which don't follow a chronological sequence. Why is that? It is because these are exactly IAS or IFRS numbers. So an international investor, for example, if he wants to refer property, plant and equipment, that is corresponding to IAS 16. So if I open IAS 16 would be property, plant and equipment. So Ind AS 16 is property, plant and equipment. IAS 24 will be related party transactions. Well, Ind AS 24 is related party transactions. So that is why we have tried to keep it consistent. We'll say foreign investor ko problem nahi hona chahiye. CA students can study, but foreign investors should not have a problem. So our sequence goes in a way. Now suddenly after 41, we go to 101, just for your understanding, so that you are aware, because when you are even auditing, you will see companies which are multinationals where IFRS may also be there. So now what happens is, till around 2007 or 8, it was called as International Accounting Standard, IAS. From 2008 onwards approximately, it became IFRS. So every standard which was issued after 2008 was called as IFRS. So for example, when we released 116, that's kind of a copy of IFRS 16. IFRS 16. Now the problem is, there are two 16s. You understand, there is an Ind AS 16, because internationally there is an IAS 16. What is IAS 16? Property, plant and equipment, which in India is Ind AS 116. Sorry, which in India is Ind AS 16. I sometimes go to sleep, you have to wake me up. Right, okay, so if I write something wrong, you should tell me, right? So over here, this is IAS 16, that is PP, becomes Ind AS 16. But then internationally there was IFRS 16. There was IFRS 16. IFRS 16 is leases. So ideally, if I follow the same thing, there are two Ind AS 16s. So what we have done is, everything which is IFRS standard is 100 and something. So 105 is nothing but IFRS 5. 116 is nothing but IFRS 16. 115, the standard on revenue, is nothing but IFRS 15. Are we clear with this? And that is why this numbering does not seem to flow logically, because you want to keep it in sync with what the international numbering, to that extent that even if you open the bare standards, you don't need to do that necessarily, but even if you open the bare standard, the para numbers are also exactly the same. The language is the same, it is at the same place, the comma, everything is the same. So over here, you have this is Ind AS 116. Are we clear with this? Yes, okay. So over here, this is your broad background. Now what do you think is more complex? Is Ind AS more complex, or is accounting standards more complex? Ind AS significantly more complex, and that is why it is there at final CA. And AS is there at CA Inter, it's significantly more complex, and as a result, what do you think? To whom should Ind AS be applicable? Should it be applicable to the larger companies, or should it be applicable to the smaller ones, or to all of them? Larger. Now that is why it is different as compared to what you studied in GST. I mean, you might not have seen that, but earlier there was service tax, VAT, etc., which was replaced by GST for everyone. Almost everyone was replaced by GST and VAT. GST got replaced, service tax and VAT. But there is a parallel framework when it comes to Ind AS and AS, and that is why a lot of you have in your articleship of audit done auditing of only AS companies. A lot of you have done Ind AS companies, but ऐसा नहीं, GST में ऐसा नहीं, everyone who is doing indirect tax would have done GST only, by and large, because the entire country is under GST, but the entire country is not under Ind AS. The bigger ones are under Ind AS, the smaller ones still follow AS. When will they converge to Ind AS? We don't know, but as of now, it is only the bigger ones. Once we have adequate manpower, honestly, talented chartered accountants like you who are capable of understanding Ind AS, enough manpower, will they move to Ind AS for the smaller entities, because a smaller entity cannot afford the big four. Ind AS is understood well by the big four and the bigger CA firms. A smaller company cannot afford them. So we want enough people in our workforce to know Ind AS really well, that even the small proprietor is able to kind of manage Ind AS, is when the smaller companies will also eventually transition to Ind AS, but this is not probably the right time. By that time, you would be a CA and probably you would be assisting in Ind AS transition, if you understand Ind AS well. Okay, so over here, we said it is applicable to the larger companies. So there was a roadmap which was given, and that is what the institute tries to teach you in this chapter, that to whom is Ind AS applicable. There was a roadmap which was given, which started in the year 1516. They said 1516, when they started, they said, let us give voluntary applicability. Let us invite companies to follow Ind AS, and whoever wants to follow it can follow it. You think it would be successful? Absolute failure. Okay, because I mean, who would want to move to a new accounting firm? We will say, okay, someone else will do, we'll copy. Why do we want to spend so much effort? So that is why it was not a success. A few companies tried to move to Indus, but majority of them did not. It is the multinationals which moved. The smaller Indian or the bigger Indians also did not move. So 15-16 was voluntary applicability. Then came into 16-17. In 16-17, this was called as phase 1. Acha, I am giving you applicability for Indus for general companies, the non-finance ones. Finance companies can include banks, NBFCs, insurance companies, mutual funds. These are not covered by this roadmap. In general, you will get an exam question on X Limited. And X Limited is not a bank, not an NBFC, not. So you will have a non-finance company, but nevertheless we'll study the applicability even for finance ones. But this is the important applicability, phase 1. How do you define a bigger company? A bigger company is defined as a company which is listed. Do you understand the words listed? What do you mean by listed? On the stock exchanges. Like in India, you have the BSE and the NSE, the bigger ones. Okay, the Bombay Stock Exchange, National Stock Exchange, there are other stock exchanges like MCX, SX, etc. But let us say these are listed or in the process of listing. Do you understand process of listing? What does that mean? If you have applied or filed what you call as a prospectus, maybe in CNTR you might have studied red herring prospectus. If you are in the process of listing, a lot of companies are getting listed in the last few years. You saw Paytm getting listed and then Paytm almost getting delisted. So you have companies which are in the process of listing. They're not yet listed, in the process of listing. So when they file their prospectus, their financials in the prospectus have to be as per Ind AS. They cannot be as per AS. Then they are in the process of listing. Are we clear with this? Companies which are listed or in the process of listing, for the timing, just remember this. Usually it is in India only. They have said in India or outside India, but typically a company which is listed outside India does not have to do reporting in India. So I can go and say, chalo, Google US is listed in the US. Google US also has to make financial. Where does Google US have to present its accounts in India? It does not have to present. So how does it matter? So sir, are companies in India listed overseas? Yes. For example, Make My Trip. It's an Indian company listed in the US. Naukri.com, Indian company listed in the US. Price Desk, Indian company listed in the US. There are companies domiciled in India, registered in India, but listed overseas because they got listed in the early 2000s, where internet connectivity was not as good and Indian investors would not understand an internet model, so they got listed in the US where the dot-com bubble had already happened. So when I say companies which are listed in India or outside India, I don't mean to cover the entire world where listed companies are there. No, I want to cover companies who are reporting in India under Companies Act 2013. If they are not reporting in India, how does it even matter? Google might have a subsidiary, Google India Private Limited, which is in India. So then it is applicable to Google India if it meets the thresholds. Otherwise, no. So don't go into that tangent that company is listed overseas, which means it has to follow Ind AS. It has to follow Ind AS, provided it has to report in India. Like Info Edge, which is a parent company of Naukri.com, is listed in the US. But it is an Indian company, it has to file to the Indian regulator. It has to report in India as well. Are we clear with this? So over here, it is listed or in the process of listing. I mean, either in India or outside India, with a net worth of greater than or equal to 500 crores. So there is a net worth limit. Process of listing with a net worth of greater than or equal to 500 crores. You understand my handwriting? Yes, okay. So it is greater than or equal to 500 crores. So this is covering the listed companies. Now, is it possible that there are big companies which are unlisted? Yes, you have Flipkart, for example. It's an unlisted company. It's such a big company, but unlisted. Parle, for example, is a very big company, unlisted company. So over here, you will have unlisted enterprises. Again, with a net worth of greater than or equal to 500 crores. So I can actually club point A and B. I can say any company in India, whether listed, unlisted, process of listing, does not really matter, with a net worth of greater than or equal to 500 crores, will have to mandatorily move to Ind AS. Now we don't have a choice. It is like, I as a student, we are forcefully going into the new course. Hopefully we are going happily because we have lesser subjects, but you don't have a choice. You are a mandatory conversion. You have to go to the new course. In a similar way, if you cross these limits, you have to follow the Ind AS. You don't have a choice in that. Are we clear with this? So these are the two main limits. We'll also go to the nitty-gritty, and I'll also check if you have any doubts or questions. Obviously you will, but we'll first understand the broad things and then go to the finer points. Okay, so what do you think? Will this limit be kind of sacrosanct in the sense that it will never change, or will this limit keep on changing as well? As years pass, will the limit keep on going down, or will the limit keep on going up? Down. It will keep on going down. They will try to include even the mid-size, smaller companies to the extent possible. The funnel will keep on getting smaller and smaller. So over here, when you go to 17, 18, and in my opinion, this is the important phase. From an exam perspective, if an MCQ or a main exam question comes, it is in almost all likelihood going to come for phase 2. Phase 1 to abhi nikal gaya, it's out. So we are about in phase 2. So when we go into phase 2, to which companies is it applicable? Companies which are listed or which are in the process of listing. Which are in the process of listing, again in India or outside India, irrespective of the net worth. Irrespective of the net worth, will have to follow Ind AS. So you understand what is meant by FIIs? Foreign institutional investors. They invest in listed companies in India. They don't invest in private companies, they invest in listed companies. So now for the FII, the entire Indian public market is open. Every company which is listed on the stock exchange has to, no matter how, what their net worth is, they have to follow Ind AS. Are we clear with this? So now the net worth limit goes out, except there's a small exclusion, except for companies which are listed on the SME platform of the BSE. There's a separate platform on the BSE called as the SME platform, though most of the times as a student you might have never seen that. All the things that you see on CNBC, the tickers that are going are all for the main platform. There's no company on the SME platform that typically appears over there. So every company that you have heard of is a company on the main platform generally. But if the question specifically comes and says, like this is a classic MCQ, like in MCQs you don't, even at CA final, when you study DT for example, PGPP computation will come as a part of your main calculations, but an exception, a proviso to that will be a part of the MCQ. So those small things have to be clear in your mind. It will never come as a bigger question, but yaar MCQ mein aa gaya to. So if a company is listed on the SME platform, sir, how will we know? The question has to tell you. If it just tells sir that it is listed, we assume that it is listed on the main platform. Do we need to write a note? No. Unless the question tells you it is listed on the SME platform, it is not listed on the SME platform. Are we clear with this? So over here, if it is listed on the SME small and medium enterprises platform of the BSE, then Ind AS will not be applicable. For every other company on the main platform, Ind AS becomes applicable. Acha. Do you think sub point B should also be same? Unlisted companies irrespective of net worth? नहीं, ये क्या होता है? It's either this or this, right? We are covering ourselves. हाँ बोला तो हाँ, ना बोला तो ना. So over here, what do you think? Is that same limit comes for unlisted companies? No, because then every company will be covered. If that is the case, you will never audit an AS based company. So over here, sub point B would be unlisted companies where the net worth is greater than or equal to 250 crores. Are we clear with this? So now we go to the finer points, we go to a bit of nitty gritty. So your net worth limit is 250 crores. Sir, what is phase 3? There is no phase 3 as yet. Will there ever be a phase 3? Yes, but not at least in the immediate 4 to 5 years. It will come, but probably a little later, once there is adequate manpower to kind of easily understand Ind AS fairly well. As of now, this is where the applicability stops, which means so this is not just 17-18 applicability, this is applicability even as we speak in the year 24-25. So in the year 24-25 also, if a company crosses 250 crores, Ind AS will become applicable. Are we clear with this? Aja. So how do we now we go to a slightly finer points. How do you calculate the net worth? What all should be a part of your net worth? Should share capital be a part of your net worth? Equity preference both? Yes, so when we calculate net worth, so your turnover, profits, none of these matter. You have done CA inter mein CSR by any chance? Corporate social responsibility. There are 2 or 3 limits. Turnover, net profit, not over here. There's just a single limit, net worth limit. So whatever be your turnover, it does not matter. Your limit is based on the net worth only. So over here, how do you calculate net worth? Sir, share capital. Which share capital? Equity. Will we also include preference share capital over here? Yes, preference share capital. What about reserves? Will you include revenue reserves like P&L, general reserve? What about capital type of reserves like a capital reserve, security premium, capital redemption reserve? Should you include them? Yes, even they are included. Remember, we are not saying net worth is not share capital plus free reserves. It is share capital plus reserves except for revaluation reserve. If you remove, let it be capital profit, so what? It is there with the company. Security premium is not revenue profit. I have issued a 10 rupee share for 1000 rupees, 990 goes in security premium. But company के पास तो 1000 आ गया ना? Yes, I can't distribute its dividend. हाँ, but my company is worth 1000. So to say no, you take only distributable profit. Why should I take distributable? I want to see the size of the company. If the company is big, because security premium was big, index should be applicable. So remember, you will take all reserves except revaluation reserve, which you think is a book entry. You have not really received a revaluation from anywhere. It's a book entry. And as a result, you will include all reserves. Whether revenue in nature, whether capital in nature, it does not matter. The only exception to this is except you will not take the revaluation reserve. Are we clear with this? Yes, okay. Now, as of now, most companies don't have it, but if they have something called as miscellaneous expenses, miscellaneous expenses which are not yet written off, like preliminary expenses that you are writing off over 5 years, underwriting commission you are writing off over 10 years. These are expenses at the end of the day. They are not assets. They are expenses. You spend 500 rupees for preliminary expense. 150 is written off. But remaining 400 is not an asset. You might be showing it on your asset side, but it is actually at the end of the day an expense. So there are certain expenses which are not yet written off. This is called as fictitious assets. Have you heard this word? Okay, tell me, is goodwill a fictitious asset? It's a real asset. You actually pay for intangible. You pay for it. It is someone's reputation. Preliminary expense is not an asset. It's an expense at the end of the day. Just that you're spreading it over 5 years. Whether you're allowed to or not is secondary. But if it was appearing in the balance sheet, we say no. These are expenses. So miscellaneous expenses which are not yet written off will be subtracted, and that will give you the net worth. Are we clear with this? Now, before we proceed further, 2 or 3 very important points to understand net worth. First, in your articleship, you might have seen companies presenting 2 sets of financial statements: standalone financial statements, consolidated financial statements. Do you think the net worth under both is the same? It is different. So, which means which net worth should you take over here? Tukka maar rahe apan. Right, okay. So, which net worth will we take? Okay, in general, okay, at least in this case, you will always take the standalone net worth. Okay, usually, a regulator always catches you through standalone, because consolidated is good from an understanding perspective. A financial investor looks at that, but a PAN number is never consolidated PAN. Standalone, company UCIN, unique corporate identification number, is for a company as a whole. Single, not for the group as a whole. Every subsidiary will have a separate PAN. Every company in the group will have a separate UCIN. Every company in the group will have a separate GST number. So if I have to check whether you have applied this properly or not, I need to look at you. Consolidated, everyone will say, not my responsibility, their responsibility. So I have to have, so almost every limit that you study, not just over here, every limit that you study is almost always a standalone limit. Because consolidated is very difficult to catch hold of a response, because there is no single number for the group as a whole. So that is why the law is very clear that this is based on the stand-alone net worth, not the consolidated one, the stand-alone net worth. The first important point. And not just this, almost every other regulatory limit also, like tax audit requirement 2 crore, 5 crore, whatever that is is based on the standalone revenue in that taxpayer's return. Everything, even GST exemption 20 lakhs, standalone GST number. It will never be a group GST number. So every regulatory limit, not just this, almost every other regulatory limit will be based on standalone limits only. Okay, so this is standalone net worth. Now the problem is net worth as on which date? Now practically as we speak, I don't think it is as complicated, but in your study material there are a few situations which happened close to a decade back, which they have asked you questions also, so we have to discuss it, but I don't think they are as important, but we'll discuss it. Conceptually, from a practical and an exam standpoint as well, in my opinion, which net worth will you take? Net worth at the end of the year? Okay, so let us say my net worth as on 31st March 24 exceeded 250 crore. है नहीं unfortunately, but let us say it exceeded 250 crores. In which case will we be covered under Ind AS? From when? From the year 23-24 or from the year 24-25? Not 23-24? Perfect. Why? Because the year is already done. Now how will we rework the entire year? We passed entries in our tally, in our SAP, considering AS was applicable. You will know the net worth at the end of the year, at the end of the year. Now how will you reframe the entire year's accounts? So like TDS also, if you know, TDS is based on the last year's position, not current year. By TDS individual HUF ko jo applicability is, in a similar way, you need to remember the net worth is seen as per the last audited balance sheet. So the net worth as on 31st March 2024, last audited balance sheet, last. So if the net worth as on 31st March 2024 becomes 300 crores, Ind AS applicability, the first financial statement under Ind AS will be for the year 24-25. Now how do you present comparative statements, etc., we'll do later, but for the timing, when will Ind AS become applicable for the first time? 24-25. What did you see? The last audited balance sheet. Why last audited balance sheet? If I look at the current year's balance sheet, I will come to know about it by the end of the year. That's too late for me to refresh the entire accounts. So I will look at the last audited balance sheet, and based on the last audited balance sheet, if my net worth crosses the limit, that is when Ind AS becomes applicable to me. Are we clear with this? Is everyone clear? Okay. Now, when you look at, let us say this situation, Ind AS became applicable to me. Things were going good, 300 crores, and then in the next year there was a big loss. My net worth went down. My net worth became 200 crores, 150 crores. It went below the 250 crore barrier, which means I can again go back to AS. Can I go back to AS? No. Once under Ind AS, always under Ind AS. Whether you decided to go under Ind AS voluntarily or you decided to go under Ind AS mandatorily, a voluntary application is also possible. But once you prepare one Ind AS financial statement for whatever reason, there's no looking back. Like you listed and then you got delisted, does not matter. You prepared the Ind AS financial statement once, you will never be able to go back to AS. You will have to follow Ind AS only. So questions might come where they might tell you that the net worth as on so and so date exceeded. You followed Ind AS. Next year due to losses, net worth fell down. We say, so what? We will still follow Ind AS. So net worth became negative. So what? We will still follow Ind AS. Are we clear with this? So once under Ind AS, always under Ind AS. Is everyone clear? Acha. So this is about the net worth. Now there are a few sums in the study material, so we are discussing that. In my humble opinion, I don't see an example, or it should not come. So when Ind AS became applicable for the first time, the cutoff date was the date of 31st March 2014. This is the cutoff date. So they said that by last audited balance sheet, nahi. You look at the net worth on 31st March 14. If the net worth as on 31st March 14 was 550 crores, is it greater than 500 crores? Yes, which means Ind AS becomes applicable. You guys tell me, from which year? 16-17. The first phase of mandatory applicability was 16-17. Sir, you said last audited balance sheet, हाँ वो in today's context. But we are going back 10 years. There are a couple of sums which the institute has added. I think it is unnecessary, but it is there, so we should be studying that. That 10 years back, when Ind AS came for the first time, they gave the cutoff date as 31st March 14 date. So if your net worth as on 31st March 14 was 550 crores, Ind AS would become necessarily applicable to you from the year 1617 onwards. Even if on 31st March 15 your net worth became 200 crores. Sir, but we are not in 1617. 1617 ka last audited balance sheet or net worth is lower, so be it. 10 years back when it came for the first time, the cutoff date was kept as 31st March 2014 date. So if as on 31st March 14, your net worth was greater than 500 crores, for example, your Ind AS would necessarily become applicable from the year 1617. Are we clear with this? Acha, I'll just try to test you. You guys tell me when should Ind AS become applicable. I have the net worth on 31st March 14. Let us say in case 1, it is 550 crores. In which year will it become applicable? 1617. My net worth is 300 crores on 31st March 14 only. 1718. Why? Because the phase wise applicability says that if my net worth is greater than 250 crores, so net worth as on which date? Strictly speaking, last audited balance sheet date. But for the first time applicability a decade back, the cutoff date was 31st March 14. So if your net worth on 31st March 14 was greater than 300 crores, your Ind AS becomes applicable from phase 2 1718, because 1617 it did not become applicable. Acha. Now comes a challenge, okay? Let us say your net worth here was 200 crores. When will Ind AS become applicable? Not applicable at all. However, this is net worth on 31st March 14. Let us say 31st March 15. Net worth is 220 crores. Is it still applicable? No. 31st March 16, the net worth is 520 crores. Applicable? Yes. When is it applicable? 1617. So what is the rule? If on 31st March 14 the cutoff limits were met, Ind AS is applicable irrespective of what happens in the future. But if on 31st March 14 cutoff limits were not met, that does not mean Ind AS is never applicable. That means you will keep on checking the last audited balance sheet. You will keep on checking the last audited balance sheet. The moment it crosses either 500, 250, whatever it is, Ind AS becomes applicable. But sir, what if it goes the other way around? What if as on 31st March 14 it was 550 crores, then it became 200 and then it became 100, then it will not, last audited balance sheet does not matter. So when will you look at last audited balance sheet? You will look at the last audited balance sheet if your net worth on the cutoff date was not crossing the limits. If it crossed the limits, then last audited balance sheet is irrelevant. I hope you appreciate the fact that from a current scenario perspective, institute will never ask you a question on this. They will ask you a question depending on when your attempt is. Let us assume your attempt is in 2025. All your questions will be year ended 31st March 25 questions, all of them. Consolidation, financial instruments, applicability, they will not be a 2014 question. I am pretty sure about it. So it's good to know because it is there in the study material, so you don't get confused. But don't read too much into this. Know your core applicability properly. Okay, bhai, theek hai, I have to see the last audited balance sheet and based on that. But by chance, I see a 2014 question, I should be aware what I need to do. Are we clear with this? So what is the rule? For the first time applicability, I will look at the net worth on 31st March 2014. If my net worth crosses the designated level on 31st March 14, phase 1 or phase 2, whatever it is, will apply. But if it does not cross my threshold on 31st March 14, I will keep on revisiting for each balance sheet and I will look at the last audited balance sheet. It's a one-way street. So if it was not applicable earlier and it now becomes applicable, you apply Ind AS. But if it was applicable earlier, like 31st March 14 ko the net worth was 550 crores and then it goes down, no, you don't say that I will not apply Ind AS. Are we able to comprehend this? Yes, so this is a special case. We'll just probably keep a note. Otherwise, in your shield, that is your concept book, almost everything is written. You can always make your notes, but almost everything is there on the shield. So if you want to make a note, it's best if you kind of scribble around over there so that when you're revising you have everything at one place. Okay, so that is regarding net worth. Which date? Last audited balance sheet. In general, except if it is applicable first time, then 31st March 14. Are we clear with this? And now coming into the most important clause. Okay, the most important clause would be, okay, you remember in CA Inter how was a private company defined? I think it was the other way around, na? Public company was defined as other, ऐसा मेरे को लग रहा है, but never, okay, maybe, you are right, okay. So, usually that was one definition, but there was something else as well. Every company which is a subsidiary of a public company will by default be a public company. Yes, okay. So over here, when you are looking at a public company definition, among other things, we encompass within us also companies which are our subsidiaries. They may be private, but if I am public, my subsidiary is private, that is also treated as a public company. Now, Ind AS applicability, and this is where Ind AS becomes really wide, and that is why so many of your clients might be following Ind AS. Listen to this very carefully, and this is important from an exam MCQ every perspective, practical life perspective as well. So if I look at Tata Motors Limited, let us say Tata Motors Limited has subsidiary 1, subsidiary 2. Below that there is a subsidiary 3, S3, S for subsidiary, J for joint venture, A for associate. Now Tata Motors is a listed company. Being listed company, will Ind AS become applicable? Yes. If Ind AS is applicable for Tata Motors, subsidiaries are all private. Let us say all of their net worths are less than 250 crores. Will Ind AS become applicable? Yes. Ind AS becomes applicable to all the subsidiaries if it is applicable directly to the holding company. Acha, let us say one of them is a subsidiary, one of them is an associate. Associate, you understand? Significant influence, about 20 to 50% stake. Will it be applicable to an associate? Yes. Will it, acha, what if it's a joint venture? Like Vistara is, for example, a joint venture between Tata and Singapore Airlines. What if it is a joint venture? Will it be applicable? Yes. What if your holding was Tata Sons, which was not a listed company, it was unlisted. However, one of its subsidiaries, Tata Steel Limited, is listed. Now, assuming Tata Sons is a company, assuming it is a company, if Tata Steel is listed, Ind AS would become applicable. Then for Tata Sons also would Ind AS become applicable? Yes. This is like in the COVID time, you remember, if one family member has, everyone gets quarantined. So it's something like that. If one person in your group gets infected by Ind AS, almost everyone will be covered by Ind AS. Your holding companies, not just immediate ones, even ultimate ones. Your subsidiaries, not just immediate one, even the step down ones. All of them. Your associates, your joint ventures, all of them will be covered by Ind AS. The only exception that they have provided is fellow subsidiary, but the nature is such that in practice, I'll just discuss, even fellow subsidiaries will, in practice what we have seen, they almost always go to Ind AS. So what happens over here is, for example, if Tata Steel, which is listed, gets covered under Ind AS, and Tata Steel has, for example, various group entities, there is subsidiary 2, associate 3, joint venture 1, for example. So if Tata Steel gets covered by Ind AS because it is listed, then will S2 get covered by Ind AS? Yes. Will associate? Will joint venture also get covered by Ind AS? Now when is it an associate? When I have more than 20% but less than or equal to 50% stake, it's an associate. When is it a joint venture? When there is a contractual agreement that they will vote together. Like in politics, we have coalition governments. Coalition governments agree to vote together. So that is a joint arrangement. Achha, Tata Steel has invested a 2% stake in Reliance Industries, for example, or X Limited, for example, a 2% stake in X. It's called as a passive investment. SI we have tried to invest. Will X Limited also get covered under Ind AS? it does not mean that 2% to Ind AS is applicable. No, that is not necessarily the case. Are we clear with this? Okay. Now when we look at, so to this entity Ind AS is not applicable. Now Tata Sons, would Ind AS become applicable? Why? Holding company, subsidiary company, joint venture, associate. To all of these it becomes applicable. Acha, subsidiary ke niche there is another subsidiary, S3. Will it be applicable? Yes, no matter how long the chain, it will be applicable. But what about maybe S4 over here? There is another subsidiary of Tata Sons called as Tata Airlines, for example. Now Tata Airlines is unlisted. Let us say hypothetically it has a bigger net worth, but let us hypothetically its net worth is less than 250 crores. Will Ind AS be applicable to S4? Ideally it would be. Why? Because by Tata Steel being applicable, Tata Sons ko applicable ho jata. And because Tata Sons is applicable, then this is applicable. Though institute gives you a relaxation over here. It says if holding company ko Ind AS was applicable directly, because Tata Sons net worth went up, then you apply, fair enough. But if holding company ko Ind AS was applicable indirectly, not because Tata Sons net worth was greater, but because one of its subsidiaries had a greater net worth, then it need not apply to fellow subsidiaries. And hence, strictly speaking, as per law, over here, Ind AS is not applicable unless S4 has a net worth of greater than 250 crores. If S4 has a net worth of greater than 250 crores, yes, then Ind AS will be applicable. I am assuming phase 2 ke aage ka applicability. I mean, obviously you can assume earlier ones, but it is unnecessary. So you can just focus on that phase 2 one. If it is greater than 250 crores, then Ind AS would become applicable. Do you see a practical challenge over here? What is the challenge? Consolidation. How will you consolidate? So when you try to consolidate Tata Sons, I will have to consolidate Tata Steel. I will also have to consolidate S4. The law is very clear. It says consolidation has to happen based on uniform accounting policies. But the accounting policies of Tata Sons are not the same as S4. It is the same as Tata Steel, but not the same as S4. And as a result, S4 will have to prepare two sets of financial statements. It will have to prepare an AS based statement for its standalone purpose, and it will also have to prepare a restated Ind AS based statement. Are we understanding it? Now, why would people do that? In practice, we are lazy by definition. एक अपने से धक्का मार के होता है. So why would people prepare two sets of financial statements? And as a result, in general, you will always see companies voluntarily moving to Ind AS. So S4, Ind AS is not mandatorily applicable, but S4 would say that for consolidating, I will have to restate my accounts into the accounting policies of Tata Sons. So I'll have to do Ind AS. So voluntarily, if I want, I make my accounts as per Ind AS only. Having said that, from a student standpoint, if you have to answer in a question that legally is Ind AS applicable, your answer is no. But you can always caveat and say that, okay, for the purpose of consolidation, I'll have to prepare a restated Ind AS financials, and hence an entity may voluntarily opt for Ind AS. But legally, is Ind AS applicable to a fellow subsidiary? Answer is no. So students tend to think of it incorrectly. Achha, what if Tata Sons was listed? Then does S4 have a choice? No. Then Ind AS is applicable because it is directly applicable to the parent. But यहाँ पे parent की applicability is indirect applicability. Tata Steel was listed, so Tata Sons was applying, and it's like your cousin relationship. Like in income tax, you have relatives, brother sisters are, but cousin brother in India you call real brother. But cousin brother is not treated as a brother from the eyes of the law. It is considered to be a distant relationship. In a similar, this is like a cousin relationship. कि यार दूर का रिश्ता. And as a result, unless the parent is covered by Ind AS, mandatorily, directly, the subsidiary, the fellow one, will not be covered by Ind AS. Are we clear with this? So let me see if you have understood this properly. So over here, let us say if you look at a group structure, let us say a sample group structure of X. Let us say there is Y, Z. Below this you have A and B, and below this you have C and D. Now A is a company which is having a net worth of, for example, 600 crores, let us say, or we say A is even listed, whatever. Will Ind AS be applicable to A? Yes. If it is applicable to A, will it be applicable to Y? Yes. What about X? Yes. Is it mandatorily applicable? Now comes the question of Z. Is it applicable? No. It is definitely not mandatory. Sir, but for X it is applicable, so ideally for Z it should be applicable. Acha, if X net worth was greater than the limits, or if X was listed, then Z ko necessarily it will become applicable. Here it is not the case, and hence Z it is not. What about C and D? Definitely no. What about B? Again, B is a fellow subsidiary, and hence this is not applicable. Having said that, for the purpose of consolidation of Y, B will have to prepare statements as per Ind AS. So for standalone, B can prepare as per AS, but for the purpose of consolidation, it will have to present restated financials as per Ind AS, because AS 21, Ind AS 110 on consolidation tell you that consolidation has to happen as per uniform accounting policies, and that is not just in India. If I look at a company like Coca-Cola India, it is a wholly owned subsidiary of Coca-Cola US. Now Coca-Cola India, just for context, has a net worth of more than 250 crores. So Coca-Cola India follows Ind AS. But do you think Coca-Cola USA follows Ind AS? No, they follow US GAAP. It's a US accounting framework. So Coca-Cola India, for its Indian reporting, will present its financials as per Ind AS. But for the purpose of consolidation, it has to restate in an Excel its accounts as per US GAAP principles, and then it gets consolidated with the US parent. Are we clear with this? So over here, these companies, Ind AS is not applicable, though if they want to voluntarily apply, they can very well voluntarily apply if they want to, though it is not a compulsion. So from a student standpoint, you have to say the legal applicability. Legal applicability is not there. Mandatory applicability is not there. Voluntarily, if you want to follow, you can very well follow. Are we clear with this? Yes, please.
So if there is a company जिसको Ind AS applicable है, तो उसके associate को भी applicable होगा, but उसके नीचे it has another subsidiary or an associate, so will it be applicable to that?
So over here, the subsidiary of an entity is treated to be same as that of the entity. So if it is applicable to, let us say, an entity, its subsidiary will automatically get covered under that.
But an associate will not be covered.
Will not be covered, but subsidiaries would be. So over here, when we look at this overall applicability, now is it possible in a different setup that your parent company is a US company, let us say X, it has a net worth of 600 crores. So is Ind AS applicable to this company? It has a net worth of more than 500 crores, 250 crores. Is it applicable? It's a foreign company. So unless this company has to do reporting in India, which in general they don't have to. So unless the question tells you that this is a company which is required to do reporting in India, I mean, sir, is it necessary? Well, it depends. Like for example, Standard Chartered Bank is a UK bank, but it has its IDRs, Indian Depository Receipts, listed in India. So it might have to do Indian reporting to SEBI, etc. So you have to see, if the question remains silent, you assume a foreign company does not have to do reporting in India. So assuming a foreign company does not have to do reporting in India, its net worth is irrelevant. Its listed or unlisted status is also irrelevant. Now this foreign company might have two companies, let us say A and B in India. Now A has a net worth of, let's say, 550 crores, B has a net worth of 150 crores. What do you guys think? Is A covered under Ind AS?
Yes.
Sure. Why is A covered? What is the reason you tell the examiner? Because the parent is covered under Ind AS? No, it is because of its standalone applicability, not because of the parent applicability. Parent has 6,000 crore net worth, 600 crore net worth or 60 crore net worth, does not matter. Why? Foreign company. Is B covered? Sure? Parent has 600 crores. Still, B is not covered because parent is a foreign company. If parent was an Indian company, then parent को Ind AS necessarily लग जाता था. Then irrespective of A and B's net worth, Ind AS would be applicable. Are we clear with this? So, in general, if we understand, for companies, Ind AS applicability, you understand their individual applicability, and then you go to the holding, subsidiary, joint venture and associate. There is also something called as a joint operation, which we will keep aside for the time being. We'll study that when you do kind of joint venture chapters. There is something called as a joint operation. Joint operation ko Ind AS will not apply. Joint venture it will apply. We will study what a joint operation is, what a joint venture is. For simplicity, joint venture is a separate legal entity. Like Tata and Singapore Airlines come together to make Vistara. That is a separate legal entity. However, they may form a partnership firm. Partnership firm समझते? General partnership. Is general partnership a separate legal entity? You might make financial statements, but the asset and liability are asset and liability of the partners. It is not asset and liability of the firm. पढ़ा है अपन ने partnership act में? Yes. So that is like a joint operation. So if you are doing a joint operation, that is you are having an unincorporated entity in the middle, we call it as a joint operation. We say, okay, to them Ind AS should not be applicable. Otherwise partnership हमको भी Ind AS लग जाएगा. So that is why joint operation, how it is formed, we will see later, much later. For the time being, just remember joint operation Ind AS is not applicable, joint venture it is applicable. You will easily be able to distinguish a joint venture and operation in due course. Okay. If parent is Indian company but has net worth below 200 crores, will Ind AS still be applicable because of applicability on subsidiary? Yes. If the subsidiary is covered by Ind AS, the parent by default, irrespective of its net worth, will be covered by Ind AS, provided it has to do reporting in India. If the parent is a foreign parent, it does not have to do reporting in India. So, what will it do by preparing Ind AS statements? To whom will it report? Are we clear with this? Any other questions, please? We'll go through the review over here, but before that, shoot if you have any other questions. Yes, we can voluntarily decide over here to follow Ind AS, but it is not mandatory. We have to first comment on the legal applicability, but yes, voluntary applicability can very well be there. Any other questions, please? Yes, please.
So in this case, all the entities will have to report for as per US GAAP also, no?
Yes, but that is not something that we have to comment on, but for their consolidation they will have to.
They will report both as per Ind AS and US GAAP.
In India, no. In India, no. In US, they will report, but that is not our lookout. What they have to do. Yes, please.
I wanted to confirm, we've written greater than equal to 500 and
Equal to. We have no. It is with equal to. So in the book as well, you can make greater than equal to everywhere. So wherever you see greater than sign, you also put the equal to sign everywhere. It is greater than equal to. Okay. So we go to our the concept book. So we have okay, are we there? Page number 1. So we have applicability of Ind AS, the phase wise applicability. It is applicable to all entities except banks, insurance companies and NBFCs. So we have studied everything for non-finance companies. For 15-16, the application is voluntary. For 16-17, mandatory application. This is called as phase 1. So you have listed entities or entities in the process of listing either in or outside India with a net worth of greater than or equal to 500 crores. unlisted entities with net worth of greater than equal to 500 crores. So here, honestly, this rule can be clubbed. All entities with a greater than or equal to 500 crore net worth will be covered. Second one, mandatory applicability. This is important. All listed entities or entities in the process of listing, irrespective of net worth, irrespective. Limits are not applicable for companies listed on SME platform. Now, some students invariably come out with a doubt saying that what if I am listed on the SME platform and what if my net worth is greater than 250 crores? Then you are not an SME only. You can't be on SME platform based on the SEBI rules. आपको 10-15 करोड़ का भी net worth उधर maximum limit रहता है. So it will never be a situation where you are a company having a 250 crore plus net worth and listed on the SME platform. It will never happen. But hypothetically, if it does, question में आ गया तो अपन ज्ञान नहीं बांट सकते. Hypothetically, if it does, then if you are more than 250 crores, Ind AS is always applicable, irrespective of your listing status. Then आपको listing status देखना ही नहीं है. But generally, it will never. I mean, it's just a theoretical, hypothetical possibility. Because the moment you are more than 250 crores, you are in the big league. You're not definitely a small enterprise. Yes, okay, on the net worth side. So that will never happen, but if it does, your answer should be based on the standalone applicability based on the net worth. 250 crores greater, it's always Ind AS applicable. Okay. Then key points on net worth, equal share capital plus reserves. This is where I see students do make a mistake while solving. They end up taking only the free reserves. You have to take all reserves except for the revaluation one. Less fictitious assets, if any, remembering items like goodwill, copyright, patents are not fictitious assets. They are intangible, not fictitious. What are fictitious assets? Preliminary expenses not written off, underwriting commission not written off, discount on issue not written off, expenses which are yet to be written off. Second, limits are applicable based on the standalone net worth and not the consolidated one, as on the last audited balance sheet. The only exception to this would be the 31st March 14 one, which we'll write as a separate note, but I don't want it to be very loud because that is unnecessary confusion. You are almost certainly going to get a question of 31st March 25, 31st March 26, depending on when your exam is. You are not going to get a 14 question. It's there in the study material because it was there as a part of the commentary. Point 3, Ind AS can be applied voluntarily or mandatorily. However, if an entity prepares its financial statements as per Ind AS in one of the years, it is required to prepare all future financial statements as per Ind AS only. Sir, does it apply even for voluntary statements? If I voluntarily go under Ind AS, then 1 year said कि भाई हमसे ना हो पाए. We want to go back. Can we go back? No. Whether it is voluntary or mandatory, it's a one-way street. You can't go back. Point 4. If Ind AS becomes applicable to one of the entities in the group, it would become applicable to all other entities of the group as well, like the subsidiaries, associates, joint ventures, parent, etc. to all of them. This is a very important point, and this is why so many companies Ind AS becomes applicable. Because actually, if you go to see, how many listed companies do you think are there in India? Around 5 to 8,000 max, including the smaller ones. So if you go to see 5 to 8,000 companies which are listed, a few lakh companies which are in the 250 crore net worth league. But other than that, the vast majority of the country is still in the AS framework. A vast majority, because the smaller companies they say that in any case a foreign investor is not going to come. It is there. Even the PE ones are largely going to come in the bigger companies, or even PE VC guys will come in the bigger companies. Private ones listed, so we have covered everyone. So largely we are compliant. As time passes and we have an adequate workforce, we'll bring the smaller companies also into our fold. Companies which are not, what about companies which are not covered under the roadmap? Will you follow AS? Yes, it's mandatory. It's either Ind AS or AS. Then you will apply accounting standards, and that's why a lot of you are still doing accounting standards. The above roadmap. But when you do financial analysis, if you want to go to equity research, etc., almost every annual report you will see, every annual report will be an Ind AS annual report for a listed company, because every listed company is preparing Ind AS only. So that means it's important. The above roadmap is not applicable to banks, insurance companies, NBFCs, as separate roadmap is prescribed. When is it applicable to banks? Not yet prescribed. RBI has deferred it till further notice because RBI wants to be clear on how its provisioning etc. will be reflected in banks. So they have deferred it till further notice. So even as we speak, companies as big as HDFC Bank are preparing accounts as per IGAAP. IGAAP is Indian GAAP Accounting Standards, AS. All banks are going as per AS. Insurance companies deferred till further notice, but from what we hear, it's either 1st April 25 or 1st April 26. It's likely to come. Ind AS, IRDA is contemplating because internationally a separate standard for insurance companies has already been announced. IFRS 17 is internationally there. It's not there in your syllabus till now because in India, Ind AS 117 has not yet been there, but probably insurance companies in the next 1 to 2 years, it's highly likely insurance companies will go under the Ind AS framework. NBFCs are already under framework. We'll see a separate rule for NBFCs. NBFCs are non-banking financial corporations. What is the difference between a bank and an NBFC? Checkbook. It's largely the checkbook. You can't have demand deposits in an NBFC. You can't just go in an ATM and withdraw money on demand. It's only a bank where you can do that. So you'll have a Kotak Bank, HDFC Bank, ICICI Bank having their ATMs. Demand deposit. You can demand money whenever you want. NBFC you can't demand money whenever you want. Check is demand money. So you can have a fixed deposit in an NBFC, but you can't open a saving and a current account in an NBFC. What do you think is more in India, NBFCs or banks? NBFCs. You see more bank branches. There are a handful of banks. There are thousands of NBFCs. Okay, so NBFCs ko Ind AS lag gaya. So RBI is seeing how well NBFCs are reacting to Ind AS, and then it goes to banks. Okay, so currently NBFC's Ind AS is applicable, but a separate roadmap, we will study that. Point 7, Ind AS is applicable irrespective of the entity being a charitable organization. In your CA interview, you see section 8 company that is a charitable organization. Even if you are a charitable organization, for example, someone like ISKCON may be a charitable organization, but if you see ISKCON, in all likelihood, it might have a net worth of greater than 250 crores. If it does, then Ind AS is applicable if it is a company, for example. Then let it be charitable organization, let it not be a charitable organization. It is applicable to all companies, including charitable organizations. Joint operation, we just put a circle out and then we'll do it along with joint venture chapter, not right now. Joint operation need not comply with Ind AS. Joint operation is different from joint venture being different. We'll study how difference it is. Things clear till now? Yes, please. So if parent company is applicable, then it is applicable to us. Even if it was an SME listed on the stock exchange, it does not matter. The parent company group is applicable, it is applicable to then the subsidiary. SME, all of this is standalone application. Merely because of this, Ind AS will not be applicable. So that does not mean you are ring fenced. If the parent is applicable, subsidiary will always be applicable. Achha. Now, it may not necessarily come, but a very interesting case can be, what if my subsidiary is a bank, or what if I am a non-finance company, my subsidiary or my parent, either way around. Like for example, hypothetically, okay, this is not how the group structure is, but hypothetically, let us say there is Bajaj Auto. Is Bajaj Auto a finance company? No, it's a bike manufacturing company largely, and then there is Bajaj Finance. Now Bajaj Finance is an NBFC. For the time being, let us assume Bajaj Finance, or there may be Bajaj Allianz. Bajaj Allianz is an insurance company. So let us say there is one, I'll put it as a bank. It's an NBFC actually, but I'm just hypothetically saying. So over here, it's a bank or an insurance company, or even an NBFC, whatever it is. Now Bajaj Auto, Ind AS becomes applicable. It's a non-finance company. It has more than 250 crore net worth. It is a listed company. Definitely it's applicable. Does that mean its subsidiary, which is a bank or an insurance company, does that mean Ind AS will become applicable to them? No. They will still, they have to, they don't have a choice. They will have to prepare their standalone records as per IGAAP or AS only. They don't have a choice over here. This is a case when you look at Future Group, for example. Future Group, there is Future Generali. Now Future Generali is an insurance company. Future Group is sitting above it. Future Group is not a finance company. Now, if my subsidiary is a bank, insurance company, NBFC, my individual NBFC छोड़ दे अभी के लिए because there's a separate roadmap. But if it's a bank and insurance company, my roadmap is a standalone roadmap. A bank and insurance company or NBFC cannot voluntarily go under Ind AS and cannot go under Ind AS merely because my group company is under Ind AS. For me, I have to look at my standalone applicability. For finance companies, because I'm covered by a separate regulator. So unless I on my own am not covered by Ind AS, I will never do an Ind AS reporting. Are we clear with this? And a lot of companies face this problem. Bharti Airtel is actually a non-finance company covered by Ind AS, but Bharti has Bharti AXA. Bharti AXA is an insurance company. Now Bharti AXA will not apply Ind AS merely because its parent is listed. No, because it is an insurance company. An insurance company will always look at standalone applicability. A bank will always look at standalone applicability, and NBFC will always look at standalone applicability. Not kind of applicability because of group companies. So over here I will still have to prepare AS, and Bajaj Auto will still prepare accounts as per Ind AS. Again, do you see a practical problem? Consolidation. Will Bajaj Finance have to restate to the extent practicable its financials into Ind AS? Yes. Sir, but we don't have to prepare Ind AS statement. You don't have to report it. Your standalone reporting will be based on AS only. But when you are consolidating, consolidation has to happen as per uniform accounting policies. So again, you will have to restate. People restate. You have so many companies, Bharti AXA, Future Generali. You will have their financial statements which are restated. As per Ind AS, they write the word to the extent practicable. Because insurance companies, they have their own challenges in reporting. To the extent practicable, you will restate that into Ind AS principles and then consolidate. This goes the other way around as well. It is possible that Bajaj Finance was at the top and Bajaj Auto was the subsidiary. So even that same logic will apply. Bajaj Finance is a bank, for example, hypothetically, or an insurance company. Will that follow Ind AS? Never. Not at least as we speak. In which case, its subsidiary Bajaj Auto, well, it will still follow Ind AS. No, but that means will the parent follow? No. For bank, insurance company, NBFC, you will always look at standalone application, not kind of a group application. If it is applicable to me, well and good. But यहाँ पे उल्टा हो जाएगा. Bajaj Auto will have to prepare financials as per Ind AS, but it will have to restate as per AS, so that it can consolidate with Bajaj Finance, for example. Are we able to understand this? तो इससे चार्टर्ड अकाउंटेंट का पेट भरता है. So much restatement is needed, so you need a lot of chartered accountants, and as a result a lot of firms do charge a hefty bill for such restatements. So that way restatement is mandatory, it is not optional, because but they write a note to the extent practicable, and wherever uniform policies are not possible, they will write a detailed disclosure why you were not able to follow that uniform accounting policies. Are we clear with this? Yes. Okay, so over here, when does Ind AS become applicable to an NBFC? The rule is +2. Whatever you had studied for the general roadmap, plus 2 years. What was phase 1? 16-17. Plus 2 would be 18-19. Second phase was 17-18. Plus 2 would be 19-20. So everything remains the same. The rules remain the same, everything. Listed or unlisted, greater than or equal to 500 crores. If it is an NBFC, then it will be the year 18-19. All listed NBFCs, Bajaj Finance, Cholamandalam Finance, Sundaram Finance, Mahindra Finance, all of these are listed NBFCs. All listed NBFCs from the year 1920, and unlisted NBFCs which have a net worth of greater than or equal to 250 crores, second phase, in the year 1920. Are we clear with this? Now, can a smaller NBFC who has less than 250 crore net worth or is unlisted, can that voluntarily follow Ind AS? No. Voluntary Ind AS applicability is not there in case of NBFCs. It is there for non-finance companies only. You can follow Ind AS if and only if you are covered under the roadmap, and you can follow Ind AS. You can follow Ind AS only and only if it is standalone applicable to you. Merely because an NBFC, ये आप बराबर से ध्यान रखो. This is a classic MCQ. Merely because an NBFC's parent is following Ind AS, NBFC will not follow Ind AS. Merely because an NBFC's subsidiary is following Ind AS, NBFC will not follow Ind AS. It is provided standalone applicability comes, will it follow Ind AS? Banks also, bank to Ind AS follow karega hi nahi. Insurance also they will not follow Ind AS unless it is needed for consolidation, they will not follow Ind AS. NBFC also can follow Ind AS, but only if it is applicable because its net worth, at least when you are writing the exam, is greater than 250 crores, or it is a listed NBFC, or it is in the process of listing. That is when an NBFC will follow Ind AS, otherwise NBFC will not. But in general, your entire syllabus is not made for banks, NBFCs or insurance companies. Almost everything that you study is for a non-finance company, but nevertheless, if it comes, you should be aware. Any problems here? No? Okay. Yes, please.
So both the bank as well as insurance company will do control reporting to the extent possible, or only the insurance company?
Both, everyone. So even a bank, let's say an HDFC bank, has so many non-finance subsidiaries who may not be banks or insurance companies. They may be holding companies for certain assets or everything. They will have to, if Ind AS is applicable standalone to their subsidiaries, they will follow Ind AS. But for the purpose of group reporting, they will have to restate based on AS, so that HDFC bank can consolidate based on AS.
And if it's other way around, then the HDFC bank will have to
restate based on Ind AS and prepare its standalone report as per AS. Okay, so when we look at NBFCs 1819, if you go to see 1819, listed or unlisted, greater than 5, again equal to dal dijiye, greater than equal to 500 crores, 1920, unlisted, greater than equal to 250 crores. Voluntary applicability is prohibited. Again, you see that word, that holding company sentence is not there. Holding parent, subsidiary, no, that is not necessary. It is your own individual standalone applicability. Okay, insurance companies, deferred until further notice by IRDA, at least as we speak. Banks, so definitely deferred until further notice by RBI. RBI has not made any kind of commitment. IRDA at least seems to be going towards 2015, maximum 2026 in my opinion. Okay, then you look at additional guidance. This is the 31st March 14 wala cutoff wala headache. So additional guidance for initial applicability under phase 1 with effect from 1st April 16, that is for phase 1 applicability, that is 16-17. Net worth on 31st March 14 needs to be checked. If company did not exist on 31st March 14 or net worth on 31st March 14 was less than 500 crores, we will continue to check for Ind AS applicability as per the last audited balance sheet. This is provided it did not cross the limit. Remember we discussed, if it crossed the limit, you will see a sum where institute has asked that it crossed the limit, but later the net worth fell. We don't care. On the cutoff date you were greater, so Ind AS becomes applicable. Second, Ind AS is not mandatorily applied to fellow subsidiary. However, parent may need to restate the financial statements of that company for consolidation. So it's not mandatorily applicable, but you might voluntarily move. Third, in case there are banks or insurance companies or NBFCs in a group, they may continue under existing AS. However, for consolidation, their financial statements may be restated to Ind AS to the extent practical. That is, if consolidation is to be done in case with a non-finance company. Good to go? Any other problems? Acha, for NBFC we don't need to check on 31st March 14. For NBFC that is 31st March 16. Everything is plus 2. So ये जो 31st March 14 which is there for non-finance company, for NBFC that same thing is there on 31st March 16. Just in case it comes, everything is plus 2. Okay? We'll quickly kind of review the questions and then stop for a break. So they are easy questions. You don't necessarily need to write. Wherever you need to write, I'll tell you. Otherwise, in the books, if you go to see, we have a question, detailed solution and some space for summary. So in most questions which are easy, you can actually look at the summary only while you are revising rather than going through the entire material. Like over here, you have a question. We have kept some space for summary. Jot down a summary. Okay, please pay attention on how you should ideally study. And while you're studying for the first time, when you do your first revision, you go through the detailed solution. While you're doing your second revision, for questions which are basic, easy, you will just look at the summary and proceed. Okay, important questions in general, if you go to see over here, we will have a QR code put next to them. Generally, the QR code has a short explanation, so I have myself recorded it. Tried to keep it less than 2 to 3 minutes, in typical sometimes less than a minute also, where questions are important and where you might at the time of revision face some questions or some doubts. So this will help you in a quicker revision. You can scan and you can kind of play that through any audio player, open audio player like VLC, Windows Media Player. It's just an open audio file, but this will be there only next to important questions. So in general, while you are revising, that does not mean you have to study only the QR coded questions. You have to study every question. These are the important ones. Barabar. So in the first chapter, there is nothing as significant, I mean, in my opinion. But otherwise, chalo, let us get started. We'll go to page 1, volume 1. Okay. So following is a snapshot of audited balance sheet of company A as on 31st March 14. So can we say we are on the cutoff date? You are on the cutoff date. Now company A's equity shares are listed on the Bombay Stock Exchange since 2010. Now you have been given a small balance sheet. As per the roadmap, which phase will company A fall into? Now will we need to calculate the net worth? Yes. In short, if I were to calculate the net worth over here, you guys tell me what all will come. Will the share, you can also write that, will the share capital come? 160. Security premium plus 200. General reserve plus 150. Revaluation reserve? No. Profit and loss 75. Liabilities? No. On the asset side, should we subtract fixed asset, investment, current asset? No. But miscellaneous expenses? Yes. Minus 80. And hence this net worth is? Acha, this is net worth as on which date? That is the cutoff date, which means when will Ind AS become applicable? 16, 17. Can we say it will become applicable in the first phase? Yes. Okay. So this is point 1. Therefore, applicable from phase 1 into bracket 16, 17. Applicable from phase 1. 16, 17. Second point, will your answer change if company is an unlisted company? Will your answer change? No, because the net worth criteria is met and the net worth criteria is the same for listed as well as unlisted companies. So, no, comma, answer remains the same. So, when you are revising for the first time, you can see the detailed solution. But for a question like this, you don't want to invest a lot of time either in your second revision nor on your exam day revision. You can just review and read. Also further, what I would suggest is from the beginning only, keep a highlighter with you, which is a distinctive color highlighter. Usually अपन सब कुछ highlight मार देते. You can do that when you are revising, that's fine, but keep a highlighter not just for our subject, for every subject, where there will be questions which are big questions. Usually on last day, you can't study everything. There are certain questions, there only 1 or 2 adjustments are good adjustments. Otherwise, question is replica. You done capital budgeting, C enter. 90% questions look similar. Some questions have 1 or 2 good adjustments. So what we will do is, we will highlight that adjustment in the question and that exact place where that adjustment is given effect to in the solution. You will highlight that single color. So for some questions, you don't need to review the entire question before the exam day, but you don't need to skip that before the exam day. So you will just focus on that adjustment and the impact of that adjustment, and that should kind of give you a good understanding. Okay, so over here, that is about question 1. Even at the start of your books, there will be a study plan which is given, where week wise, this is while you are doing the classes, watching or going through the lectures. Then for revision, we have a separate video. I'll just share that, but revision is a slightly far away. First, let us at least you will have 4 tests as at 25% of your course. Approximately after every month there will be a test. So ensure that whatever happens, you are on speed with that, and MCQs every chapter. When happens, you kind of do the MCQs. If you have any questions, we can discuss that. So chapter MCQ together, the test will be a descriptive test. MCQs, what you will be solving will be chapter to chapter. Yes? Okay. Chalo. So let's proceed further. We'll go to question 2. Any problems here? Aja. Let us say in illustration number 1, the balance of the profit and loss account is a negative 375 crores. Is it possible? Can you have a negative profit and loss? Yes. Internal reconstruction. You see a lot of P&L debit balances, that is negative profit and loss. When should Ind AS be applicable to company A? And will your answer change if company A is an unlisted company? Okay. So if my net worth over here has a P&L debit balance, so if I try to find net worth on 31st March 14, again it will be the same thing, 160 plus 200 plus 150. Okay, now instead of 75 over here, what will we write down? Minus 375, and then there will be minus 80 as usual. So if I calculate this, how much do I get? 55 crores. You guys tell me. Question says, when should Ind AS become applicable? Will it be applicable under phase 1? Will it be applicable under phase 2? Yes or no? Very nice. Why yes? Listed company. The question tells you that it is a listed company, and if it is a listed company, even if the net worth does not cross, Ind AS will be applicable, not in phase 1 but in phase 2. And as a result, over here in subpoint 1, if, what is this company? If A is listed, comma, Ind AS applicable from 1718 into bracket phase 2. So here this net worth calculation is also not required. Sir, so why are we doing calculation? Because for all you know, it may also come to be greater than 500 crores. Then we don't have to wait till 1718, then 1617 applicability. Second, will your answer change if A is unlisted company? Now will your answer change? Yes. Ind AS not applicable in such a case. Point 2. Yes, your answer will change. Ind AS is not applicable. Good to go? Okay. Next you go to question number 3. The net worth of company B, which is an unlisted company, was 600 crores as on 31st March 14. Let us say the question stops. Does Ind AS become applicable? Yes. From which date? 1617, phase 1 applicability. However, due to losses incurred in the year 14-15, the net worth of the company was 400 crores on 31st March 15. Does it matter? No. The net worth on the cutoff date is greater than the limit, so Ind AS becomes applicable irrespective of future changes. From when shall company B apply Ind AS? From when shall it apply Ind AS? 1617. So net worth into bracket 31st March 14. 600 crores. Therefore, Ind AS applicable from 1617 into bracket phase 1. Into bracket irrespective of future net worth irrespective of future net worth. Okay, usually these are just general cases we are discussing, but otherwise when it comes as a sum, typically I don't see a full-fledged sum on this. I mean, till now it has not come on this chapter, but usually you divide your answer in 3 parts. A case-based question, explain the law, as per Ind AS so and so. Like यहाँ पे you will say as per the applicability roadmap, you will explain the law. Okay, net worth as on so should be so and so. Second paragraph will always be connecting the law to the given case. In the given case, the net worth of the company on so and so date is so and so amount. Part 3 of the answer, conclusion. Conclude and say what is. Do we have to reproduce institute language? Not at all. Not at all required. You can refer any even top AIR certified copies and you will see that they don't reproduce. They can't humanly reproduce institute language. It is not required. Focus your attention on understanding. I can't comment on subjects like audit or earlier I think ITSM etc. were there where people say you have to reproduce institute language. In financial reporting, even in AFM, absolutely not required. As long as you get the message clear in your own words, 100% it works, right? So don't unnecessarily invest your time in remembering all of those things. Focus your time in getting the understanding and reproducing in your own simple words. That definitely works. Okay, so you have question number 4. The net worth of the company C, an unlisted company, was 400 crores on 31st March 14. However, the net worth of the company was 600 crores as on 31st March 15. From when should it become applicable? 1 or 2? Ideally, it should be phase 2 because cut-off date के हिसाब से तो 250 crores it is crossing and 250 crores goes in phase 2. However, we have said that when do you see the last audited balance sheet? You will see last audited balance sheet if on the cut-off date it is not applicable or it is not going in the first phase, then you can keep on applying. So here, as per the cut-off date, it is going in phase 2. But subsequent to that, if it is an early application, that is fine. Later, delayed or no application is not permitted. Are we clear with this? So over here, there was at that point, and that is why there was something called as ITFG. ITFG was called as Ind AS Transition Facilitation Group. In income tax, have you heard about something called as advance ruling? Advance ruling, nice. So it means that before you actually go and fight a case in the court, you go and tell them, see, this is my problem. What do you think should be my answer? You ask the tax authority only. So they will give you advance ruling. In a similar way, there was an ITFG, Ind AS Transition Facilitation Group, ITFG. And ITFG at the time of transition, a decade back, had given you such clarifications. So these questions are taken by the institute directly from the ITFG bulletin, and ITFG did not need any clarification. Now law is very clear. So iske liye you see these questions. Otherwise, that cutoff date is long past. So over here, you will have as per 31st March 14 net worth, comma, Ind AS applicable as per 31st March 14 net worth, Ind AS applicable from 1718. Full stop, however, comma, as per 31st March 15 net worth, comma, Ind AS applicable from 1617. and hence application starts from 1617. The general rule you'll remember is they try to ensure that Ind AS is applicable earlier. Whichever rule makes you apply Ind AS the earlier, that rule is usually taken from the 31st March 14 context. Barabar? In today's world, we will just look at the last audited balance sheet. There is no cutoff date now. Okay, next you go to question number 5. Company D is the parent company of Group A. A is an unlisted company having a net worth of 60 crores on 31st March 14. So D seems to be the parent. Then A is an unlisted company having net worth of 60 crores, and following are the other companies in the group: B, who is unlisted, subsidiary of A; C, who is unlisted, subsidiary of B. Okay, so it seems, if I go to C, it seems this is question number what? Question number 5. There is D at the top, then comes A, then comes B. There is also C, right? And then comes C. Let us look at the net worth. I don't have D's net worth, but I have A's net worth. Achha, is A listed or unlisted? Unlisted. U for unlisted, and what is the net worth? 60. Now if you go to B and C, they are also unlisted. Achha, nothing is given regarding parent D, whether it is listed or not, so we can ignore that. What is B's net worth? 600 crores. And C's net worth? 150 crores. So looking at this, what do you guys think? Will Ind AS be applicable to B? Yes. If it is applicable to B, does it automatically apply to its subsidiary C? Yes. To its parent A? Yes. Ultimate parent D? Yes. Everyone? Yes. So over here, D, A, B, C, all will apply Ind AS from, achha, which phase? Phase 1, that is 16-17. This is phase 1, 16-17. They've given the answer for company A, B and C because we don't know whether D is an Indian parent or not, so they've kind of been discreet and silent regarding D. They have not said that it is not applicable to D. They have not said it is applicable to D. In my opinion, if nothing is given, you can safely assume it's an Indian parent. So ideally, it's not just A, B and C, even D, who is the parent, it should be applicable to D as well. Okay. Next you go to question number 6. Following is the structure of company D. So you have company D. U is a subsidiary, F and G, F is a subsidiary, G is an associate, H is a subsidiary, I is an associate. Now all the companies in the above structure are unlisted companies, and the net worth of company E is 300 crores. This is company E. Net worth of all other companies is below 250 crores. To which company would Ind AS become applicable? Be a little slow. If you want, just write down next to each of them. A for applicable, NA for not applicable. Look at mandatory applicability, not voluntary applicability. Are we done? Okay. So by default, Ind AS becomes applicable to E. If it becomes applicable to E, will it be applicable to a subsidiary? Associate also? Sometimes the question might give you passive investment. Passive investment is 1, 2, 3, 4, 5% stake, for example. Will it become applicable? No. Does it become applicable to parent company? Acha, now comes a problem. Fellow subsidiary. H, does it become applicable? No. Associate? Not applicable mandatorily. However, for the purpose of consolidation with company D, H has to present its accounts as per Ind AS restated. So, if required, H can voluntarily restate if it wants, otherwise not needed. So, over here, you will have D, comma E, F, G, mandatory application. From which date? Phase 2. Applicability from 17-18. H, comma I can follow AS, comma, however, for consolidation, H, comma I can follow AS, comma, however, for consolidation with D, they will have to prepare restated Ind AS FS. FS is financial statements. They will have to prepare restated Ind AS financial statements.
If the company G would have been a subsidiary, so F becomes fellow subsidiary, but still it will be applicable.
Sorry, come again.
If the company G is
G.
a subsidiary,
Is a subsidiary, okay.
so F becomes a fellow subsidiary.
हाँ, that does not matter. F का लेना देना है नहीं, because application comes from parent company.
So still F will
Yes, it will still be covered. Both of them will still be covered because parent is covered under Ind AS. In your question, if E did not have net worth greater, if F had net worth greater, then the question would be G को applicable है या नहीं है. Then G भले associate है subsidiary, it will not be applicable. Here E is application, so definitely it will be applied for both. Okay, so this is question 6. Next you go to question number 7. Okay, now AB Inc. incorporated in a foreign country has a net worth of 700 crores. It has two subsidiaries, X whose net worth as on 31st March 14 is 600 crores and Y whose net worth is 150 crores. Whether X and Y would be required to follow Ind AS from accounting periods commencing on or after 1st April 16 on the basis of their own net worth or on the basis of net worth of AB Inc. So they are asking you two questions. First, will they have to follow Ind AS? And second, if they have to, what is the reason? Is it own net worth application or is it parent net worth the reason? So if I look at no, but for whom is it applicable? Now AB Inc. For AB Inc. is Ind AS applicable? No. Why? Foreign company. So if it is a foreign company, it does not have to do Indian reporting. So it does not have to do reporting to Ind AS. Why should it be applicable? So it's like Coca-Cola US will never prepare its accounts as per Ind AS. They will, they don't have to report in India. Coca-Cola India Private Limited might have to. Coca-Cola US does not have to. So over here AB Inc. it's a foreign company. So since it is foreign, colon not applicable. Let the net worth be 700 crores. Let the net worth be 7,000 crores. It does not matter. Ind AS is not applicable. Now below AB Inc. there is company X company Y. Company X ko will it be applicable? Why is it applicable? Because X's net worth is more than 500 crores. Not because of parent net worth, because of own net worth. Applicable since X net worth is greater than 500 crores. Why is it applicable? Not applicable. No sir, but my parent is having a greater than 500 crore net worth, so be it, it's a foreign company, and hence not considered. Not applicable. Y net worth is less than 500/250 crores. So basically, to whom is it applicable? Only X. Based on whom? Own net worth. Are we done? Okay. So that is question 7, and I think we'll go to the last question, question 8. Now, as per the roadmap, Ind AS is applicable to company X from the financial year 17-18. Question itself is telling you that it is applicable from the year 17-18. How, we don't know, but it is applicable from 17-18. Company X, a non-finance company, is a subsidiary of company Y, who is an NBFC. Okay, which means, can we say NBFC Y will also apply Ind AS from the year 17-18? Very nice. NBFC applicability is its standalone applicability, not based on group applicability. So, who is the parent here? Y. Is Y an NBFC? Yes. And its subsidiary is X, which is a non-finance company. Now, company Y is an unlisted NBFC having a net worth of 400 crores. Company Y is unlisted and your net worth is 400 crores. Have they given you the date? No, so we'll assume that is the latest net worth or the net worth on the cutoff date. We don't know. What will be the date of applicability of Ind AS for company X and Y? X ka to they have directly given only. For X and Y, if Ind AS applicability date for parent NBFC is different from the applicability date of the corporate subsidiary, then how will the consolidated financial statements of parent NBFC be prepared? So we'll see that. First of all, for the non-finance company, Ind AS will be applied on from which date? Why 17-18? Well, it is given. We don't know kya reason hai. Whatever be the reason, it is given as 17-18. Now, merely because Ind AS becomes applicable to X, does it become applicable to Y? No. So I'll check for my standalone application. My standalone application, I am unlisted and my net worth is greater than, 250 crores, less than 500 crores. So as an NBFC, what is the year when it becomes applicable? Perfect. This becomes applicable from 1920. So for 2 years, I think 17-18 and 18-19, Y and X will prepare accounts as per different frameworks. For the year 17-18 and 18-19, if I go to see, for the year 17-18 and the year 18-19, Y will prepare as per AS. Y will prepare as per AS, whereas X has given is going to prepare as per Ind AS. I think from the year 1920 onwards, both of them will prepare as per Ind AS. So the question is asking you two things. First, it is asking you when will Ind AS become applicable. So we say okay, 17-18 for X and 19-20 for Y based on standalone application. However, it is also asking you that how will consolidation happen? Whose accounts will be restated? X ke accounts or Y ke accounts? Whose accounts will be restated? X. It is always subsidiary who restates as per parent policy. The subsidiary is X. ये NBFC का कोई लेना देना नहीं है. You have to remember, irrespective of who is NBFC, ask yourself who is the subsidiary. Subsidiary यहाँ पे X. The rule in consolidation is it is always the subsidiary which restates as per the parent's policy and not vice versa. So Y will continue to present its accounts standalone as well as consolidated as per AS. X will restate its accounts for the year 17-18 and the year 18-19 into accounting standards for the purpose of consolidation while it continues to present its standalone accounts as per Ind AS. From the year 1920, everyone is preparing as per Ind AS, so no restatement is needed. However, if the structure was inverted, that is, the NBFC was a subsidiary and the parent was a non-finance company, still the position would remain the same. It is just that the NBFC will have to restate its accounts into Ind AS, that is as per the parent's policies. Are we clear with this? Yes? Okay. So over here you can say that for 17-18 and 18-19, X will restate its financials. X will restate its financials to AS for consolidation. For consolidation with Y. For 17-18 and 18-19, X will restate its financials to AS for consolidation with Y. Any problems? Okay, so it shall apply from 1st April 19, that is the year 1920 onwards. For the purpose of consolidation, for financial year 17-18 and 18-19, X will prepare its individual finance statements as per AS. That is your summary solution. Perfect. Okay, so any other problems, queries, doubts? Right? So we'll stop for a break. We'll usually have a 20-minute break on Sunday and 10 minutes break on other days. Okay, so we'll stop for a 20 minutes break and be back. We'll continue. We'll start with the new standard. Okay, so settle down everyone. We'll start with the next topic, Ind AS 16, property, plant and equipment. In terms of importance, I would put this into the tier 1 category in terms of its importance. 1 being the most important, 2 being average important, 3 being the least important. So PP is, silence please. PP being a tier 1 category topic, it's a very important topic and this is the start of your asset link standards. So in the beginning we do asset link standards, PP, intangibles, impairment, a lot of these standards are asset based. Then there will be liability based standards, etc. But PP forms kind of the base of that. Definitely an important topic, tier 1 category in terms of importance. So what have you studied a standard for this earlier? Yes, goes under the heading of AS10. AS10 is on property, plant and equipment. A similar Ind AS 16 is on property, plant and equipment. Now, what does this standard seek to cover? What are the topics which largely this standard seeks to cover? Before that, what all is PP? Can you give me some distinctive features or examples of PP? Plant and machinery, okay. Furniture, land and building, etc. So that these are generally examples of PP. But does that mean for every company this will be treated as property, plant and equipment? Well, let us say if I am Toyota Motors and if I have a car, is that PP for me? No, that car is typically inventory. So when I look at PP, what are the core features of a property, plant and equipment? Typically the core features of a PP are First it is tangible. How do you define tangible? Well, tangible means it has physical substance. What we used to say, can touch, feel, see. So that is tangible. Because there are certain assets which are intangible as well. There are certain assets like goodwill, patents, etc. which are intangible, which are not covered under this standard. There is a separate standard for the same. Okay. So over here, this is tangible. Second, you guys tell me, what is another feature of a PP? One is it is tangible. Second, it is held for use in the ordinary course of business and not held for sale in the ordinary course of business. Items like inventory are actually held for sale in the ordinary course of business. PP is held for use. So if we as a coaching institute have a car or a bus that is held for our use, and hence that is considered to be a part of our PP. But for Toyota that is held for sale, it is considered to be a part of its inventory. Okay, is there anything else that is considered while you consider PP? Life, long term in nature. The life is usually greater than or equal to 12 months. So items which may, like pens for example. Now pens are also held for use, but typically they are consumed over the course of a year, and as a result they don't go into the PP criteria. Are we clear with this? So typically for something to be shown as a PP, the life should be greater than or equal to 12 months, and that is when it is taken as PP. Now from a practical standpoint, there are also items which have a life of more than 12 months held for use and tangible, but they may be immaterial. If they are immaterial, as per materiality concept, you can expense it out. Like for example, calculators. You are very attached to your calculators typically. So that way calculators usually have that life of more than 12 months, held for use, tangible as well. But if your CA firm has around 10-20 employees, they have given them maybe 100-200k duplicate calculators, and there is hardly, for example, 3,000-4,000 worth of total collective asset. It does not make sense capitalizing, depreciating. So in practice, if items are immaterial, you can expense out. As a student, we don't have to gauge materiality. If a question says X purchases an asset for 100, we think 100 is material. We don't act smart. 100 is immaterial, so expense no. Unless a question tells you, we will not check for materiality. So we will not go into that materiality angle. But other than that, there are three features. Tangible, you don't need much explanation. Life more than 12 months, you don't need much explanation. Use is a problem. Now people kind of don't understand use as well. What do you mean by use? Use is different from revenue generating capability. What does a student tend to think? Okay, use means it should be generating revenue, like a machinery makes units which I can sell, generate revenue, and as a result machinery I can say is revenue generating. Okay, use may be giving you revenue, may not be giving you revenue. For example, if you go to a big multinational company, in their reception there is a big modern art painting over there. Does it give any revenue? No. But does that mean it is not a PP? It is a PP. It is held for administrative use. It is a part of office decor. It need not build a revenue link. So a student thinks by only that item which gives me revenue is PP. No. Item, it is not defined as assets which are capable of generating revenue. No. They are defined as assets which are held for use. Use can be administrative use. Use can be selling and distribution use. Use may be finance, accounting, anything, but it is held for use. Are we understanding it? And as a result, we don't have, like even a pollution control equipment, for example, a pollution control equipment does not generate revenue for you. However, if it is installed as a part of your overall environmentally conscious management practice, it is held for use, and hence it is a part of PP. So the larger definition of PP would be assets which are held for the purpose of use and not for the purpose of sale in the ordinary course of business. And use can be any kind of use. Like if you go to, I mean, you might have seen videos of companies like Google, etc., where they have for their employees Xbox, PlayStation, gyms, etc., and then we see our office. So that is for employee welfare, but that is also use. It is shown as PP for the purpose of, let us say, Google. PP is assets which are held for use. Please don't think that this does not generate revenue, so it is not PP. Revenue generating assets are PP, but they are not only the assets which are PP. They should be held for use, and use is a much more broader term, including assets which you are renting out. If you have a car and you are renting out a car, that car is generating income for you, and your usage over here is kind of generating a rental income. So for you, it is going to be shown as a PPE, for example. If you are given it out on rent, you give out, so let's say you are in Goa and you have that small, let us say two-wheeler, and you are giving it out on rent to people for 5, 10 days. Oh, that is PPE for you. You are not probably doing own use, but at the same time, you are generating a rental usage out of it. Usage is usage. Are we clear with this? Yes? Okay. So these are the three distinctive features of a PPE. Now, every item which is a PPE gets covered under this standard. There are a few scope exclusions. At the beginning of every standard, there will be a scope exclusion. Scope means what is covered. Scope exclusion is what is not covered. So, there may be certain items which tick off all of these three categories, but they are not covered. That is called as a scope exclusion. Usually, when is it not covered? When there is usually a separate accounting standard for the same. In law, you had a rule specific overrides general. So, if there is a specific law, it will override a general law. So, over here, there is a separate standard called as, Ind AS 105. It was not there earlier during your accounting standards. It is called as non-current assets held for sale. All of this is there. So, when you look at scope exclusions, in scope exclusions, if there is an item which is a non-current asset held for sale, it's a very important standard, Ind AS 105. So earlier what used to happen is I would buy this bench. Where will bench appear in my books as a coaching institute? Property, plant and equipment, furniture and fittings. Now sooner or later, some or the other day, I would decide to sell this bench. If I decide to sell this bench, does it get sold overnight? No, but now my intention has changed. My intention earlier was that the bench can be used. Now my intention is no longer using it. I want to sell it. So can I classify it as inventory now? Why no? I'm not selling it in the ordinary course of my business. Inventory means otherwise, so I have a big plot of land, I decide to sell it, suddenly my inventory ratios will go for a toss if I show it as inventory. I'm not holding it for sale in the ordinary course of my business, I can't show it as inventory. But then it is not even appropriate to show it as PP. So अपना बीच में लावारिस जैसा हो जाता है. It is not even a PP, it's not even an inventory. Where should it go? So there's a separate standard called as non-current assets held for sale, Ind AS 105, where they will say that usually till the time you are using an asset, you show it under PP. The moment you decide to sell, the moment you sell it, the asset goes out of your books. But when you decide to sell, you have not yet sold it, it takes some time. You will reclassify it, move out of Ind AS 16 and go into Ind AS 105. So it may be an item which is tangible having a life of more than 12 months, still it will not be covered by Ind AS 16, it will go under Ind AS 105, non-current assets held for sale. Easy? We will study a separate standard 105 later. Second is usually assets which are mineral rights or mineral resources. Mineral rights / resources. Usually you have something called as E&E assets over there, called as exploratory and evaluatory assets, like oil and gas companies. Now oil and gas companies would explore and extract out oil. As a student you would say, okay, there is exploration going out, but before that there is a lot of exploration that goes out. Imagine in this wide surface you have to pinpoint a small area where you will do drilling. It is a very costly exercise to narrow down on the place where the drilling should actually happen, and hence a lot of money spent over there for these mineral resources, for which a separate accounting standard exists called as Ind AS 106. That standard was earlier there in your syllabus, then neither the student nor the examiner understood what was there, because nor the professor. So because it was very technical, topographical, seismic things, because it was linked to mining. Now those terminologies we are honestly not very aware, so institute took a wise decision to remove it, and it is now no longer applicable. 105 is there, 106 is not. But you need to know that if there are exploratory and evaluatory assets, they are not covered by Ind AS 16 because there is a separate standard called as Ind AS 106 which covers those exploratory and evaluatory assets, and 106 is outside your syllabus. It is not there in your syllabus from 2018. This is 1 or 2 attempts it was there, after that they removed it, and rightly so. Because of highly being technical in nature, we don't understand the terminology over there. These two are fairly basic. The third one, in my opinion, the scope exclusion, is the most important one. It is biological assets. Do you understand what is meant by biological assets? What is a biological asset? Living asset. Assets which have life. Can you give me some example? Livestock, for example. I mean, livestock is cattle, etc. Anything else? Sorry? Articles. Okay. So over here, when we look at biological assets, these are usually living assets. Assets which have life. Now, why do you need a separate accounting standard? I mean, is it tangible? Livestock? Held for use? Having अपने आप को मत सोचो, livestock की बात कर रहे हैं यार So held for use and life of more than 12 months? Yes. So why would I need a separate accounting standard? There is a separate standard, and that is very important from an exam perspective. You have to identify what goes where. Usually certain categories of biological assets. So you'll have biological assets for agricultural purpose. There is a separate standard called as Ind AS 41. An interesting one which is there in your syllabus, Ind AS 41 on agriculture, and hence biological assets are not covered by Ind AS 16. Earlier you did not have a separate standard for livestock or biological assets, now you do. But within these biological assets, you need to be very careful which biological assets are excluded. So over here, there is a biological or a living. Someone even said employees, etc. Are employees covered under biological assets? Just to kind of discuss that. Yes or no? Why? That's right, control. Remember, when you look at an asset, forget biological, forget tangible, forget intangible. It has to be asset. And how is asset defined in your CA foundation? How is it defined as basic? An asset is a resource controlled by the entity. Controlled by the entity due to past events for which we are expecting to receive future economic benefits, blah blah blah. But it has to be controlled by the entity. If an asset is not controlled, if something is not controlled, it can't be your asset. Land, building, machinery is in your name. Livestock is in your name. You can tie the livestock. हमारे इतना खराब हालत नहीं है. So over there, livestock can be controlled. Human resources cannot be controlled. And as a result, in general, there are certain exceptions we'll study later when we do intangibles. But in general, employees, human resources, though having life, as someone pointed, employees, we will not be covering this in any standard. Let alone biological, tangible, it will not be covered in any standard, because in general, there may be certain exceptions like clauses in a contract which show control. Like for example, big football players. Now they might have huge penalty clauses. If they were to break the deal with a club, they have huge, humongous, hundreds and millions of dollars में उनको pay करना पड़ता. That might show control. Okay, by even if I want to, I cannot leave this club because I'll have to pay such a huge penalty. But in general, an employee can give 1 or 2 month notice, maybe a few hundred or few thousand rupees as penalty, and that's it. In which case, that is not strong enough to show control. अभी control है या नहीं वो fact to fact है. We are not going to that tangent, but I want you to be clear that when we are discussing biological assets under Ind AS 41 or any asset, I'm not including human resources over here. It's a drawback in accounting that human resources cannot be got into your books of accounts. Like self-generated goodwill, companies which are so big, I mean like Coca-Cola, Google, their goodwill is much bigger than all their assets put together. You can't get it into your books of accounts. It's self-generated. It's accounting constraint. In a similar way, human resources, like talented people like you, cannot go into the balance sheet because of the accounting constraint. So we will not keep human resources into the discussion. We are going to other than human resources, that is living animals, living plants. After that death, it's no longer a biological asset. Then it goes into another standard. So for the timing, we'll say biological means living. The moment it dies, maybe an animal is slaughtered, it is inventory for you. But till the time life exists, biological. Till the time life exists, Ind AS 41 applies. So biological assets for agricultural purpose, I will split this into 2 types. I will split this into living plants and I will split this into living animals. when I look at living animals, provided they are used for agricultural purposes. We will study technically what agriculture is when we do Ind AS 41, but I think you have a broad understanding about agriculture kya hota. So animals which are used for agricultural purposes, like cattle, etc., will go under Ind AS 41. They will go under Ind AS 41. But so this is all animals used for agricultural purpose. But the problem is living plants. When I look at living plants, I think you might have done this even at CA Inter. There are two types of living plants. There is something called as bearer plants and other than bearer plants. Now, this is why I would put this to be the most important in the scope exclusion section. Because यहाँ पे ऐसा नहीं कि भाई 16 will not apply and this will apply. Non-current asset held for sale for everything 105 applies. But for bearer plants, Ind AS 16 applies. For other than bearer plants, Ind AS 41 applies. For all animals which are used for agricultural purpose, Ind AS 41 applies. Emphasis on the words for agriculture purpose. Like if I'm Amul and I'm having cow to kind of milk it, animal husbandry, that is an extension of agriculture. That will be covered under Ind AS 41. But if I have a dog, a security dog, a dog giving me security is definitely not an agricultural activity. And as a result, a police dog is not covered under Ind AS 41 because it is not agriculture. Ind AS 41 is agriculture. The heading of the stand is not biological asset, it is agriculture. So items which are used for agriculture go over there, not all items. So animals which are used, all animals which are used for agricultural purposes, and we'll study what agriculture is later, but all animals which are used for agricultural purpose go under Ind AS 41. Plants, whether agriculture or otherwise, if they are bearer plants, they will go under Ind AS 16. Other than bearer plants, they will go under Ind AS 41. So if you see a question, you will have to read the question and identify whether that plant is a bearer plant or other than bearer plant. Because your accounting will be completely different depending. There has been a question which came for a tree called as Pineus radiata tree. अपने को zoology करना पड़ेगा because Pineus, but they will explain what a Pineus radiata tree does, and based on that you will have to judge whether it is a bearer plant or other than bearer plant. Now, what do you mean by bearer plants? Bearer plants refer to plants which bear agricultural produce and are not agricultural produce themselves. Again, bearer plants refers to plants which bear agricultural produce but are not produce themselves. Like for example, mango tree, a coconut tree, they will bear produce, they are not produce themselves. However, when you look at a bamboo plantation, the bamboo sugarcane plantation, they themselves are the produce. A teak wood or a timber plantation, they themselves are the produce. Whereas a mango tree, apple tree, coconut tree, all of these, the tree itself is not the produce. It bears the coconut which is a produce. But in a teak wood plantation, a timber plantation, the tree itself will be chopped down being the produce. Are you getting this? So when you look at bearer plants, these are plants which bear agricultural produce and are not produce themselves. Are we clear with this? So if I ask you for Pineus radiata which came in the exams, a Pineus radiata tree is a tree which has a life of 30 years and eventually will be used for building materials and furniture items. Is it a bearer plant or other than bearer plant? Which means it goes under which standard? 41. This is how you had to read and understand. They will explain you what the tree does. But you need to know what is a bearer plant and other than bearer plant. Are we clear with this? Yes? Okay. So, a bearer plant will be covered under Ind AS 41. Ind AS 16, and other than bearer plant will go under Ind AS 41. Now, as a thumb rule, not mandatory, but thumb rule, fruit plantations and cash crops. Cash crops, remember? Tea, coffee, rubber, cotton, and fruit plantations will be typically bearer plantations. Typically, mango, coconut, your apple, etc., orange, these will be bearer plantations. Even tea, if you've been to Kerala, Assam, etc., people don't really uproot the tree. I mean, they just take the leaves, chop it and have it at a manageable height. So the tree over there, the tree, actual tree, If you want, you can open the balance sheet of companies like Tata Consumer, Tata Tea, Tata Global Beverages, and you see that they will show their tea plantations as bearer plants to be covered under Ind AS 16. So tea plants, like companies like Tata Tea, will take that into their bearer plants because they bear the tea leaves, which is a produce, and they themselves are not the produce. They will go under Ind AS 16, property, plant and equipment. However, other than bearer plants like a teak wood plantation or a bamboo plantation, etc., will all be other than bearer plant, will go under Ind AS 41. Are we clear with this? Now at the end of the day, bearer plant bana, so it will go under which standard? 16. But 16 is PP. Now comes a bigger issue. A lot of your crops that you see, wheat, jawar, bajra, etc., where will they go? A wheat plantation, a bajra plantation, food grains for example, where should they go? Do they bear produce, that is the grains? So they are not the produce themselves, they bear those grains which is harvested typically. So ideally they should be bearer plants. However, if they are bearer plants, they will go under the PP heading. But PP ka one of the core features is that the life has to be more than 12 months. If you see, if you kind of this glance through when you travel by trains or roads in the village side, you have this Kharif and Rabi season where there will be a plantation. The moment it is done, it will be chopped off, a new plantation comes. And hence these crops typically don't have a life of more than 12 months. If they don't have a life of more than 12 months, they can't be bearer. For it to be bearer, just bearing produce is not enough, because if they are bearing produce, they will go to PP. But then the life should be more than 12 months. So the second feature of a bearer plant is, first feature, it should bear produce. Second feature, the crop or whatever that is has to have a life of more than 12 months. If it has a life of less than 12 months, okay, we can't take it under the bearer category. Even if it is bearing, let it go under Ind AS 41. So if you are a farmer and if you are following Ind AS, then you need to remember that your croppings will actually go under Ind AS 41 rather than going under Ind AS 16. Are we clear with this? And all animals will go under Ind AS 41. So if you look at listed companies, like for example, there's a company called as Venky's. Now that is in poultry, and they have a lot of poultry animals, and as a result, if you open their balance sheet, you will see a lot of bearer if it is a plant, but यहाँ पे तो bearer है ही नहीं, तो यहाँ पे you will see a lot of Ind AS 41 being applicable, and it's a very good balance sheet, Venky's, for your understanding of Ind AS 41. They have a good poultry operation. So that ways you will see that how living animals are accounted for in general. Are you clear with this? Cooperatives like Amul. Amul is actually a cooperative, not a company. So you can even look at how they account for cows for the purpose of their balance sheet. Are we clear with this? So tell me, are all biological assets out of Ind AS 41? No. Which biological asset is still under Ind AS 16 and which is under 41? Bearer plant comes under 16. Other than bearer plant? अच्छा, animals also bearer and other than bearer classification? No, करने को हो सकता है. A sheep is a bearer animal. A sheep का wool is the produce. Sheep itself is not, the wool is the produce, but there is no segregation between bearer animal and other than bearer animal. The segregation only exists in plants. So if an accountant, and this is a typical exam question, कि भाई accountant does something and आपके जैसे expert के पास आया जाता है कि whether the accountant is done a correct treatment or not. So the accountant will say, I want to show a bearer animal. We'll say there is no concept of bearer animal. Why not? We'll see that later when we do Ind AS 41, but there is no concept of bearer animal, and hence whether animal is bearer like a sheep or a cow is a bearer animal. I mean, it's the milk is the produce, the cow is not the produce. We don't segregate it between bearer and other than bearer. It is only a plant which is segregated between bearer and other than bearer. Are we clear with this? All animals for agricultural purpose is under Ind AS 41. But if there is an animal like a racehorse, is an animal not used for agriculture purpose, used for racing purpose, well, that can't go in the agriculture standard. तो फिर वो किधर जाएगा? Well, it is held for use, tangible, life of more than 12 months, not covered by the scope exclusion, goes under Ind AS 16. Even a racehorse goes under Ind AS 16, a security dog goes under Ind AS 16 as long as they are not held for the purpose of agriculture. Racing is definitely not agriculture, security is definitely not agriculture. What is agriculture? It's a separate standard, we don't want to go into that right now. Are we clear with this? Is everyone clear? Yes, okay. So this is your scope exclusions. in my opinion, the only thing where you can be tricked on is biological. You will get a general question and you will be told solve. You as a student will have to gauge कि भाई कौन सा standard has to be applicable, and that is where you can be tricked. Otherwise, so 105 etc. is very direct. 106 तो है ही नहीं आपके syllabus में. So if we look at page number 27 on your concept book, page number 27. Over here, usually the QR codes that is there on your shield will be video codes. On your volume 1 and 2 and 3 will be audio codes. So if you open this, next to every topic there will be a video which will summarize the entire topic. Next to a question will be the question audio which will summarize the question generally. Okay, so key terms: PP, tangible, held for use, life of greater than 12 months, greater than equal to. Definition of PP, well, these are the three features. Scope, Ind AS 16 excludes non-current assets held for sale. Why? Well, they are covered by 105. Exploratory and evaluatory assets linked to mining operations. Why? They are covered under Ind AS 106. And point 3, the important point, biological assets for agricultural operations except bearer plants, because they are covered by 41. Now, biological assets for agriculture are living assets. They are usually living plants or living animals. Ind AS 41 applies to all animals which are used for agricultural purpose, whereas bearer plants, Ind AS 16 applies. Other than bearer plants, Ind AS 41 applies. Okay, what is a bearer plant? These are living plants which bear produce, like a coconut tree, and is not agriculture produce themselves, like a bamboo tree. Is it clear? Bearer. Second, they are expected to bear produce for more than 12 months. Sir, why? Because if it is less than 12 months, like an annual crop, it will not survive for 12 months. How can you call it as a PP? Because a bearer plant will go under the PP heading. So if it is less than 12 months, let's skip out the bearer plant and let it go to 41 only. For example, a wheat grain plantation will bear wheat for less than 12 months and will be chopped off, and hence it is not a bearer plant. So in my opinion, point 1 and 2 are the important points. Point 3 is the clarification point. What do you mean by clarification point? Now, even a mango tree, ultimately once it gets old, will be chopped down and sold. So one can always argue that the mango tree itself is also the produce. But वो logic से तो when you buy a PP, you also calculate salvage value. You believe ultimately it is going to be sold. Does that mean PP is inventory? No. I mean, the ultimate sale is ancillary. It is incidental to your main objective. It is not your primary objective. Are you understanding this? So we will not say, हाँ, ultimately तो even mango tree is going to be chopped down. हाँ, but your primary objective is the produce. What is sold ultimately is like salvage. It is incidental in nature, ancillary in nature, and hence it cannot be treated to be a part of your other than bearer plant merely because the tree is going to be chopped down. So they are just clarifying. They are saying that there is a remote likelihood of the plant itself being sold as a produce, except for incidental scrap sales. I don't think that this mango tree, coconut tree is going to be sold unless I have to scrap it off at the end. Otherwise, my idea is not to hold it as a produce for the tree. Are we clear with this? So this is just kind of a clause which is clarificatory in nature. Okay, people don't say, no, ultimately you are going to chop it down, so this is also other than bearer plant. That is incidental in nature. A mango tree is held for the mangoes, that is a produce. However, ultimately the tree may need to be cut down and sold. Classification will be based on the primary intention, and hence it is a bearer plant. Are we clear with this? Any problems here? No? Acha, reference point, unless given otherwise, fruit trees, tea, coffee, rubber plantations are bearer plants. Generally for direct cases like a grapevine, like a mango tree, they don't generally tell you. I mean, they expect you to know. But for a fairly not so common plantation, they will guide you what it does. But general fruit trees, you can always safely assume that they are bearer plants. Tea, coffee, rubber, safely assume they are bearer plants if it comes in the exam. Are we clear with this? Okay, now you start with the main standard, Ind AS 16. So now you know what is covered by 16. Now what do you want to learn? What is a standard? Standard is different people might have different bases, and hence accounting may not be comparable. So we want to do standardization. So over here for PP, what do you want to have standardization on? सबसे पहले initial recognition. Most of these charts are there in your books, so you can decide if you want to note them, but it's not mandatory. So initial recognition, you guys tell me, ideally initial recognition should be at what level? How will you initially recognize a PP? Cost, at fair value, at cost or NRV, whichever is lower. At what value will you record? Cost. Perfect. Initial recognition happens at cost. But what all should be included in cost is what we will study over here. अच्छा, it is not necessary, mind you, at C-Enter maybe आपने इतना ध्यान नहीं दिया होगा, but it is not necessary that the initial recognition happens at cost. For example, in case of a biological asset, Ind AS 41 does not tell you initial recognition will be at cost. We will study that. They will say initial recognition happens at fair value less cost to sell. Why? Ind AS 41, I am telling you, for biological assets, they will tell you initial recognition happens at fair value, not at cost. In general, आपने C-Enter में सब जगह पढ़ा initial recognition cost. Why? Not necessary. It is because of the special nature of the item. Like a biological asset reproduces. So when you look at an asset which is reproducing, आपका उसमें कोई रोल नहीं था. It is more of an asset. The cost is zero. The cost is zero. In no time, आपका पूरा PP zero हो जाएगा. If you because largely the breed of cattle, if they reproduce, that will be your new cattle. You might have purchased 100 cows. In 10 years, that will be depreciated, and now you don't need to purchase 100 new cows. वैसे तो आपका पूरा breed zero हो जाएगा. And hence they say no. We want to show the asset base in the books. So let the asset appear at fair value. A newborn calf has fair value. It does not have cost for you. You did not pay anything, but it has fair value. So they said, okay, let's initial recognition be at fair value. But at PP level, assets in general, PP level पे, there's no such constraint कि भाई मेरे को fair value लेके आना पड़े. So what I pay is the initial recognition value, and hence my initial recognition should happen at cost over here. But there will be multiple standards, financial instrument, biological, जहाँ पे initial recognition may not be at cost. So don't assume it by default कि भाई initial तो cost पे ही होना चाहिए. Generally is that it is at cost, but there will be places where it will not be at cost. Second, okay, so we'll see what is going to be there in initial recognition. Today's class and a large part of even tomorrow's class will go for initial recognition only. Next is subsequent expenses. What do you do with the subsequent expenditure if you remember? Do you capitalize or do you take it to the P&L account? Depends. This is the safest bet. If you don't know anything, you shall depends. So here it depends on whether it increases life or efficiency. If it increases life or efficiency, capitalize. But otherwise you expense it to P&L account. In general, there are a few special cases for each of them. Then is subsequent evaluation. At each balance sheet date, like inventory, AS2, you show inventory initially at cost, but at each balance sheet date you show inventory at cost or NRV, whichever is lower. In a similar way, PP, in your understanding, at each balance sheet date will be shown at same cost or NRV, whichever is lower. No, why no? Well, PP is not held for the purpose of sale. What does it matter what the NRV is? It does not matter what the NRV is. If you buy a car, you turn that ignition on, get it home, the car becomes a second-hand car. The value drops by 20%. That does not mean you record a write-off the moment you buy the car, because you're not holding the car to sell. How does it matter whether the NRV falls or increases? And hence, assets are typically shown at cost less accumulated depreciation, or in certain cases, revaluation model is permitted. But otherwise, it's not cost or NRV, whichever is lower, it is cost less depreciation, if any. And in certain cases where revaluation is permitted, then you take the fair values. And last is a very important point on depreciation. How should you depreciate? What is component method of depreciation? A lot of things. So these are the four major heads. Picture of. these are four major heads where you are going to recognize your PP principles. We'll focus now on the first head. The first head is initial recognition. You said initial recognition should be at what? Cost. Tell me what all should come under cost. Let us say I'm a trader. I'm not making my own machinery. Self-constructed भी हो सकता है, purchase machinery भी हो सकता है. Let us say I'm purchasing something. So if I want to figure out what should be a part of my cost, guide me with this. For a purchased asset, what all should be a part of my cost? Should the purchase price be a part of my cost? Yes, usually purchase price should be. What about taxes? When you look at 100 plus 18, you see the bill at 118, you are paying 118. Will your PP be recorded at 118 or will it be recorded at 100? Depends. Why? If it is creditable, then you will record it at 100. What is the journal entry? Journal entry is PP account debit 100. Input GST receivable account debit, नाम कुछ भी देते, input GST account debit 18 to bank 118. Are we clear with this? 18 is not my cost. However, for you as a student, do you have a GST number? No. And as a result, for you look at the final bill. For you, GST is not creditable. So for you, if credit cannot be claimed, then what is the cost? 118. You would pass the entry asset account debit to bank. So if you are buying a mobile phone, for you the price of the mobile phone is, let us say 100 plus 18, that is 118. But for an organization who is buying mobile phones for its employees and is able to claim credit for the same, the mobile phone is 100 rupees only. Sir, 18, we will claim a credit. Do we understand broad credits? So we are solving an FR paper, not an IDT paper. So how will we know that an item is creditable or not? Usually the institute should tell you. But if it does not, the thumb rule in general from what we have seen the past trends is they assume GST to be creditable, everything else to be non-creditable. Everything else, well, can be stamp duty for land, can be import duty if you are buying something, can be local taxes and levies, can be some purchase tax. Unless given otherwise, we always assume that everything else is non-creditable. GST we assume as creditable. If the question remains silent, you always need to write a note. So if you are writing plus, let us say import duties into bracket assume non-creditable. So you keep it consistent, but having said that, if you assume it is creditable, then you can always write a note. In my opinion, it should sail through, but might as well follow the institute trend. Take GST to be creditable unless given otherwise. Every other tax, stamp duty, import duty, local taxes and cess, purchase tax, entry tax, everything to be non-creditable unless the question tells you it is creditable. So over here you will add what you call as non-refundable or non-creditable taxes. Are we clear with this? Or non-creditable taxes. Okay, apart from this, what all can be a part of your cost? Freight. Okay, which direct cost? When we say direct cost, which direct cost are we saying? So basically the general rule is every expense that you incur to bring the inventory in the ready to use condition, that is a condition as desired by the management. So let's say you are an Indian company, you are importing a machine from Germany. So the purchase price, import duty is definitely a part of your cost, but at the same time the transit, freight inward, the loading unloading charges, maybe even the insurance that you have taken to protect the machinery in transit, packing, unpacking, everything till the time the machinery comes, again loading, unloading, installing, all of that till the time the asset is ready for use. All the expenses which are incurred to bring the asset in the ready to use condition are called as directly attributable expenses. Now whether it is directly attributable or not is a subjective thing, but in general you have to look at it from a fact by fact basis. So to this you will add what is called as directly attributable expenses. This can be including items like freight inward. This can include items like installation. If you buy an air conditioner, maybe 30,000 rupees you buy an air conditioner, but you need someone to fit that air conditioner. maybe 1000, 1500 rupees are charged. That is directly attributable to getting the AC in the ready to use condition. Maybe you need a point, a powerful point which can carry the AC load. You get an electrician to put that point. He charges you another. All of these are directly attributable to get the AC in the ready to use condition. Are we clear with this? But the moment the AC is ready for use, after 3 months you do servicing. That is not initial cost. That is after the asset is ready for use, we will go to the P&L. So is it possible to define an exhaustive list for? No, it is impossible. So the standard keeps it open. Remember IFRS, Ind AS are principle based standard. US GAAP is a rule based standard. For everything they will give you a rule. But IFRS is principle based. They will keep it open to you and assume that you are doing good faith accounting and apply that in good faith. Right? So directly attributable expenses. Now IFRS tells you a list of 4 or 5 items which it says will not be directly attributable. I'll again repeat, they will tell you 4 or 5 items. Just a negative list suna hai apna. They will say this is not, everything else can be. But this is not. What are these 5 items which IFRS Ind AS mention are not directly attributable? First, they say inauguration expenses. So if, for example, you have set up a state-of-art office building, will the cost to construct that, like cements, bricks, labor, will that be a part of the cost? Yes. But let us say you call, let us say, Deepika Padukone to cut the ribbon. Now she charges you a bomb. Will that increase the cost of your office building? That is inauguration expense. So standard says that this is not directly linked to the acquisition of the asset. Why was there a need to clarify? Because there were a lot of contentious cases where, I mean, as Indians we come from a very religious background. So in general, usually we do things like Bhumi Pujan and stuff. Pandit ji comes, Pandit ji ne nariyal toda. Uske baad so we say all of that is also inauguration expense. The standard says, okay, even if that is happening, that Bhumi Pujan is not directly attributable to getting the asset in the ready to use condition. Any kind of inauguration expense at whatever time it happens will not be a part of the cost. And hence inauguration expenses will not be included. Like if you remember a few years back, Ahmedabad mein that Motera Stadium was there, which is now Narendra Modi Stadium. Donald Trump had come. Itna kharcha kiya tha to inaugurate. That does not increase the cost of the stadium. That does not increase the cost of the stadium, and as a result it cannot be capitalized. Or the Ram Mandir that happened now. You cannot capitalize it into the cost of the temple. There may be a huge expense to start it that does not increase the cost of the temple. And as a result, every kind of inauguration. So otherwise people would have said, no, if Modi ji did not come, things would not have happened. But that does not increase the cost of the temple. All of that is not a debate for the purpose of cost of the asset, and hence every kind of inauguration expense, well, you can't add it. So that is the first item. Are we clear with this? Second is, if you are incurring certain cost or losses after the asset is ready for use. Income tax has a slightly different view. Remember, income tax law is different, books of accounts are different. Like for example, Jio, when it came, a lot of you might have Jio SIM cards. When it came, Jio gave you SIM cards free of cost. So Jio has this huge optical fiber network, the telecom network, there are thousands of crores. That optical fiber network was very much ready for use. But it gave SIM cards free of cost. It gave you data, everything free of cost. For 3 or 4 years, it incurred huge losses. A question may arise that these losses should be capitalized along with the cost of the network, because that made the network very profitable. उसके वजह से in record time, world में इतना fast किधर भी नहीं हुआ है, किधर भी नहीं. The number of users that enrolled, that was because I incurred the loss. So a thought can be, let me capitalize these losses into the cost of my fiber optic network. My fiber optic network is 10,000 crores. I incurred 5,000 crores of losses for 5 years. So shouldn't my fiber optic network now be worth 15,000 crores? Is that correct? No. कोई बोलता है कि नहीं, but that increases the benefit. Cost का definition is not something which increases the benefit. Cost is what you pay till the time asset is ready for use. Or network is ready for use. Now you charge the customer, you don't charge the customer. That is your sales decision. That does not mean your network was not ready for use. Your network was ready for use. To increase the gains in the future, you decided not to charge anyone. That does not mean कि आपका नेटवर्क रेडी नहीं था, आपका नेटवर्क तो रेडी था. When does the cost cutoff date arise? The cost cutoff date arises the moment the asset is ready for use. An argument always comes कि नहीं, because of the losses I am getting higher benefits in the future. Because I incurred those losses, I am getting higher benefits. But the definition of cost is never, initial cost is not expenses you incur to increase future benefits. I hope you understand. Definition of cost is expenses you incur to get the asset in the ready to use condition. The moment you get it in the ready to use condition, cost recognition stops. उसके बाद खर्चा है P&L में जाएगा. So the standard clarifies any expense or loss that is arising after commercial production starts will go to the P&L. You can't capitalize it into the cost of the asset. Are we clear with this? Second thing. Now income tax, if you are, some of you are doing in tax, income tax has a different say on it. There are different case studies on that. But that is income tax law. Don't confuse the two. Both of them are two different laws. Income tax recognizes a lot of items different from books of accounts. Like block method of depreciation. Books थोड़ी ना करता है वो सब. Right? Are yes or no? Okay. So this is the second thing. अच्छा, what was the first thing which is not a directly attributable item? क्या बोल रहे हो? Inauguration. Okay, sorry. So inauguration expense. Second is what? Losses or expenses after commercial production. Third is a very tricky and contentious point. Very debatable. Third and fourth both. Staff training. Staff training. Now a lot of people used to capitalize staff training. Now the standard says that is actually not correct. Maybe I was following a manual system of accounts. Now I decide to digitize everything. I bring laptops and everything. No, my employees don't know anything. उनको तो कुछ भी नहीं आता है, तो मैंने उनको भेजा NIIT, Aptech and I did a training. Does that increase the cost of my laptop? Laptop is ready for use. My employees don't know how to use it. That does not make the laptop more costly, which is logical in a way, but then some students always argue. I mean, and if you look at even aircrafts, a lot of aircrafts are purchased, but pilots need training on that aircraft. Now that may be technical in nature, the standard says yes, but that does not make the aircraft more costly. Your manpower does not know how to use the asset, you are training the manpower. Boeing is selling aircrafts, let us say to Indigo, and these are new aircrafts. Boeing is giving training to Indigo pilots. That does not make the aircrafts more costly. Your employees don't know how to use an asset does not mean the asset's cost should go up. And that is a very important clarification, because earlier we have seen a lot of people who would directly add staff training to the cost of the asset. कि हाँ ठीक है, this is the thought earlier was कि if my employees don't know how to use the asset is not ready for use. But the standard says no. The asset's readiness is not linked to your ability to use it. Or I mean, your employees don't know how to use it. The asset is capable. Otherwise, आप गाड़ी खरीदोगे, then you do a driving course. That does not make your car more costly, right? Your car is car का cost. You don't know how to drive. That does not make your car costly. So that training expenses, standard has said yes, there may be debatable items, but we believe that the training expenses in the language of the law, expenses which are incurred to train or to operate in a new environment, they should be expensed off. Yes, please.
Sir, if like two airlines, there's a deal between two airline company and the seller sells the training services along with the jet or something.
So you can segregate the invoice, no? Based on the fair value. So invoice value can very well be segregated. Even when you will study further, when you buy an AC or when you sell an AC, it comes with so-called free servicing and free warranty. The standard says कि भाई वो लिखा रहेगा free. It's not actually free. You segregate it. So you will have to. There will be principles whereby you will segregate it, and the part which is attributable to acquisition of the asset will be capitalized. The part which is linked to that is legal nature. That is not necessarily the case. If it is genuinely free, it will be free on standalone basis. There are principles where you will figure out whether it is actually free or not. Merely because when Voltas sells an air conditioner, it says free AC service, free warranty. The standard says ऐसा कुछ भी free में नहीं होता. If it is free, then it must be free on a standalone basis as well. If I just go and tell them कि चलो यार free में servicing दो, will they give? No. No, there are certain items which are free. If you go to a restaurant, you ask for water. That is free. That is genuinely free because it is free on a standalone basis. But if something is not free on a standalone basis, it's actually not free. Then you'll have to allocate. अपन आगे जाके allocation principles देखेंगे. But they have cleared the air on the fact that ideally you should not be taking staff training into the cost fundamentally. अभी आप उसको segregate कर ही नहीं सकते. That's an accounting constraint. But if you are able to segregate कि भाई ट्रेनिंग के लिए इतना कॉस्ट के लिए कितना, then you have to remove the training part. If you are unable to segregate, to the end of story, then it's an accounting constraint. You can't segregate it. Then what will you do? Are we clear with this? This is the third thing, and the fourth is relocation. You understand relocation? What do you mean by relocation? Relocation itself means that the asset is currently in the location and condition which I desire. Now I am relocating it. So the standard says relocation expense should definitely not be a part of my initial cost. Subsequent cost, it should be a part or not, we will decide when we do subsequent expenditure, but initial expenditure no. Like for example, hypothetically, okay, I believe that this AC is very lucky for me. I say कि मैं जिधर भी lecture लेने जाऊंगा, I will take this AC along. Does that mean every time I dismantle and put an AC in a new location that increases the cost of the AC? No, it is already in the location and condition is desired. I keep on relocating it into 10 different places. That does not make the AC more costly. So they say no, that should not be the case. Sir, but काफी बार बच्चे बोलते कि sir relocation increases the life and efficiency. If it does, तो subsequent expenditure में जाएगा. We are not studying subsequent expenditure. We are studying currently initial expenditure. So now we can say AC is being installed at a new place. Arey, it was already installed. 30,000 plus 2,000, I have already recorded 32,000. I am again dismantling, putting into a new place another 2,000. Then again taking to a new place another 2,000. That does not increase the cost of the AC. You are taking it 10 different places. That is not the AC's problem. The AC is recorded at 32,000. Every subsequent relocation or retraining expense should go to the P&L account. At least at the initial level. At a subsequent expense level, if you can prove that this is an expense which increases the life or efficiency and which may need capitalization, then you may capitalize if it increases the life or efficiency. But otherwise, initial expense, definitely not. So what are the 4 items which will not be a part of the cost of the asset? Inauguration expense, losses or expenses after the asset is ready for use, training, very important, training expenses, relocation or retraining expenses. So all of these will not be taken as a part of the cost. Apart from that, this is for a purchased asset. What if I were to manufacture an asset, make an asset? You visualize the cost sheet. What all comes in the cost sheet? Is material cost? Yes. So if I am making a factory, the material cost, brick, cement, etc. will definitely be a part of my cost. What about labor cost? What about overheads? There are 3 types of overheads. There is production overheads, selling and distribution overheads, administrative overheads. Fixed variable बाद में. But will all the 3 overheads be capitalized in general? No. Which will be capitalized? Production for sure. Whether it is variable, sir, variable meaning power cost. So if I am constructing a factory and I need power, power cost is directly attributable to construction. It is production in nature. Will be capitalized. Sir, what about fixed production overheads? Yes. What do you mean by fixed production? You see so much construction happening. There are big cranes. Now, I might not own the crane. I might take the crane on rent. But yeah, if I am paying rent for constructing my building, that rent that I am paying is directly attributable to construction of my building. Production overhead, fixed production overhead. Are we getting this? That will also be a part of my cost. What about admin and selling and distribution? Will they generally be a part of cost? No. Even in my cost sheet, my cost of production would have ended at the overhead level. The production overhead level, factory overhead level. उसके नीचे admin selling will be cost of goods sold side पे. But my cost of production usually ends, admin and selling come below that. They are not directly attributable to the construction and hence usually admin expenses, selling and distribution expenses will not be a part of the cost of the asset. Are we clear with this? A very important point where students usually, I mean it's just tested once, is you might see something like this. You might see material cost of 100. Will that be a part of cost? Yes. Labor cost 50. Will that be a part of cost? Yes. Then you will see depreciation on equipment used to make the building or make the plant. This is another 50. Will this be a part of cost? Depreciation on equipment which is used to make your asset. Will this be a part of cost? No, this is the general answer I get. Why no? Depreciation. Already claimed as expense. No, वैसे तो material can also be already claimed as expense. Labor can also be already employee benefit expense में जाएगा. Should depreciation be a part of the cost? You understand what depreciation this is? I hope you are not confused. बच्चे क्या मानते हैं? They think this is depreciation of my asset. How can it be depreciation on your asset? वो तो ready for use ही नहीं है. Depreciation starts the moment the asset is ready for use. Think of it this way: I'm building my headquarters. I'm building my office. Till the time my office is ready for use, depreciation cannot start. तो सर ये कौन सा depreciation है? यार I don't need to take a crane on rent. I own the crane. The crane has a depreciation of 200 rupees for the entire year. It's a 2000 rupee crane. I've used that crane. मेरा खुद का crane है. It is there in my balance sheet as PP. It is ready for use. That crane is going to be depreciated for 200 rupees in a year. Out of that 200, for 12 months, 3 months have been used for my building. So I've allocated 3 months exactly to my building. Usually my entry is depreciation account debit 200 to crane 200, and depreciation being a nominal account, I transfer P&L account debit to depreciation. But do I necessarily need to transfer the depreciation to P&L? No. Even if it is directly attributable, आप मेरे को एक बात बोलो, if I had taken the crane on rent and I paid rent, would that be a part of my cost? So if I own the crane, I don't have to pay rent. Does that mean that the asset is now cheaper? No. I had to pay for the asset, and a part of that depreciation is attributable, directly attributable. Just to give you an analogy, almost everyone and almost all of you said no, it should not be a part, and it's very normal. Everyone does that. Ask yourself, when you did CA Inter or CA Foundation, when you prepared the manufacturing account, in the manufacturing account, did depreciation of factory come? Did depreciation of factory come in the manufacturing account? Yes. When you prepare the cost sheet while preparing the fixed factory overheads, did the depreciation on factory go into, which means it goes into the cost. There is no एक thought process करते हैं, but depreciation is non-cash, it should not be a part of cost. We are not doing capital budgeting. We are doing accounting. In capital budgeting, you focus on cash flows. Here you are not focusing on cash flows. Let the expense be cash in nature, non-cash in nature. As long as it is an expense, it is an expense. Depreciation is not cash in nature. It is not कि भाई वो expense ही नहीं है, expense है. So to think a depreciation on some equipment should always go to the P&L is wrong. If that equipment, like a crane, which was ready for use, was used partly during the year for my construction, then the depreciation on that crane, which is attributable to my construction, should be capitalized. So the total depreciation may be 200. I will not capitalize the entire 200 because I have not used the crane for entire 12 months. For this building, I have used it for 3 months. So allocable part may be 50 rupees. My journal entry will be depreciation account debit 200 to crane 200. P&L account debit 150. Building account debit 50 to depreciation 200. Don't go into that wrong presumption that depreciation cannot be a part of the cost of the asset. Obviously, it can never be depreciation of your asset which is being constructed. वो तब तक ready for use ही नहीं है. But depreciation on other equipments which are used to make your asset will very well be a part of cost. You have been doing this since your CA foundation. Manufacturing account had a depreciation as a part of manufacturing cost. Cost sheet at CA Inter had depreciation as a part of your fixed production cost. That is the same thing that Ind AS 16 is also trying to tell you. Are we clear with this? So don't think that this has to be cash cost only, it can be any cost. Are we clear with this? Are yes or no, any problems? Okay, so this would be directly attributable expenses. Now, can we proceed? Achha, what about discounts? If I get discount, should I subtract the discounts while calculating? Always? Trade discount gap. Generally accepted accounting practices tell you कि by trade discount should be subtracted, but generally what do you do with cash discount? Don't record any. Let's say you have, okay, let's put it this way, there is a 100 rupee machine, forget, there's nothing else, no taxes, no directly attributable expense, 100 rupee machine, you have very good negotiating capability, you got a discount of 10 rupees because you negotiated hard, you got the asset at 90. Cash discount, trade discount. Trade discount. How do you define a trade discount? Every discount other than cash discount. How do you define a cash discount? Discount linked to early payment is cash discount. This 10 rupee discount is not linked to the fact that you are paying early. This 10 rupees is because you negotiated hard or you buy in bulk. तब वो discount मिला. That is trade discount. That is not cash discount. In which case, what is the journal entry? 100 का चीज MRP 100, you got it at 90. What is the journal entry? PP account debit to bank 90. 100 rupee asset. Usually the normal credit period is 1 or 2 months, 3 months, whatever it is. The supplier says if you pay it immediately, instantly, I give it to you at 90. Otherwise, you pay me after 3 months. What is the journal entry? PP account debit what? 100 to bank because I have done immediate payment. How much? 90 to what? Discount received. Where will the discount received go? P&L. It is treated to be financing in nature. And as a result, we say that trade discount is linked to the asset per se, whereas cash discount has no connection with the asset. It is because you are paying early कि आपको discount मिल रहा है. And hence cash discount should be taken to P&L separately. But trade discount should be reduced while calculating cost. It's a generally accepted accounting practice unless the standard tells you other way around. This is the general practice that you follow. You have been doing this since quite an early age. Trade discount, subtract everywhere, not just over here. Even when you do sales, revenue mein your sales is net of trade discount. Cash discount is a discount received or discount allowed that you show. That is to be shown separately. So over here for the timing, let us say I will show this as less trade discount. Is everyone clear? Yes, okay. So now we'll pinpoint items which are quite important, okay? In your across the chapter at certain sections, all of these are decent enough. But what is most important is this part over here, the present value of site restoration. In either of these cases, this is present value of site restoration. In this section, I would put the maximum weight behind understanding site restoration. ये सब आपको समझ में अच्छा बात है. Purchase price. So, are you following me? अच्छा. Initial recognition happens at cost for a purchased asset. Purchase price plus non-creditable taxes, less trade discount, plus directly attributable expenses, plus something called as PV of site restoration, which we are yet to do. Then on the self-constructed asset side, material cost, labor cost, production overhead, production, not admin, not selling and distribution, production. Production can be fixed or variable, which can include cash production overheads. It can also include non-cash allocable production overheads like depreciation on another equipment used for my asset. Includes everything. Plus borrowing cost. We have not studied this till now, but in CA Inter you might have studied AS16. Have you heard about the concept of qualifying asset? Typically qualifying asset is an asset which necessarily takes a substantial period of time to be ready. So if you are, what is substantial period of time typically? More than 12 months typically. So substantial period of time, if it takes, then it can be a qualifying asset, in which case we can say that borrowing cost can also be capitalized, but that is relatively less. Usually it is not a qualifying asset, in which case most assets get ready in less than 12 months. If it takes more than 12 months, then qualifying and you can do capitalization. There's a separate standard dedicated towards that. And then again PV of site restoration, we'll understand what that means. First we'll look at this note on directly attributable. What are directly attributable? Well, these are expenses directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in a manner as intended by the management. Both English likha hai. Basically it means ready for use. All expenses that are incurred to get the asset in the ready to use condition should be capitalized. But following items will not be considered. Will not be considered. as directly attributable. First, inauguration expense. Second, losses or expenses incurred after, emphasis on the word after, the asset is ready for use. Third is cost of staff training or operating in a new environment or with a new set of customers. I mean, new set of customers means, for example, language training. You have a German client, you are teaching your employees German so that they can interact properly. That does not increase the cost of your asset, for example. Relocation expense and usual admin and general overheads. Are we able to understand each of them? Acha, now before you go to site restoration, which I think would be a fairly complex thing, we'll just understand one or two other points that you should be aware of. We have studied about directly attributable expense, but is it possible that you can generate some income during the course of construction? Usually not, but is it sometimes possible that during the course of construction you fetch some income? अपना भी वही हालत था, right? Okay, so over here can you fetch certain income? What do you do with that income? Let us say there is directly, or let's say income during construction. Income during construction. You have two options. Will you reduce it from the construction cost, or will you directly take it to the P&L account? Sorry? Depends. Acha, chalo. Depends on what? Now you tell me. It depends on what? Okay, so how do you say it is directly attributable? For example, let us say I am constructing a building in a redevelopment project. You understand? Now in a redevelopment project I am incurring demolition cost. Is demolition cost directly attributable to construction? Yes. But when I demolish, I get certain debris. I sell those debris. I have incurred 50 rupees to demolish, and after demolition I get a 10 rupee debris. I sell that 10 rupee debris. I get 10 rupee of income. Bank account debit 10 to what? Will I take the 10 rupees to the P&L, or will I deduct it from, let us say, the asset or demolition cost to get the net cost of demolition? Net cost. It's a directly attributable income. It is an income which is directly linked to a cost of construction. And as a result, if it is directly attributable, if it is a directly attributable income, what do? I will net it off. I will deduct it from the cost of the PP. Does that mean that all incomes are directly attributable? Not necessary. For example, you are constructing a building, and let us say a film director like Rohit Shetty or someone comes across. You might have seen Bollywood movies. Most of them have their underworld dons in under construction building. So you say last fighting udhar hi hota hai, building mein hi hota hai. So over here they say ki, this is perfect building for shooting the last 1.5 months. He comes to you, you charge him, let's say 100-200 rupees, whatever is as rental for shooting in that building which is under construction. Is that 100 rupees of income directly attributable to your construction, or should it go to the P&L account? It has no connection with your construction, and it's not directly attributable to your construction expense. And as a result, if it is not directly attributable, your concept is the same. If it is not directly attributable, then you take it to the profit and loss. Over here, you will deduct. The most common thing that the institute typically asks in this section is, they will tell you that we acquired a plot of land where construction is going to happen in phases. Phase 1 construction has started, but remaining land is lying vacant. We give it on rent for car parking, and we earn some car parking income. So I have 10 acres of land, 2 acres I am doing construction, 8 acres are lying vacant. So in that 8 acres I am allowing people to park their cars, and I am charging some rental income for that. Where should that go? Should it go to the P&L, or should it reduce the cost of my construction? P&L. So this is a very standard, it goes to the P&L. It does not, I mean, to be honest, that land is ready for that for the car, I mean, it's a vacant plot of land. It has no direct connection to construction, and hence in general this should go to the P&L account. Institute also takes it to the P&L account. This is the most common heading when it comes to directly attributable incomes. And what about, so this is done with directly attributable incomes. What about wastage? Have you heard about wastage? There are two types of waste. One is normal, one is abnormal. What do you do with normal loss? GAAP. GAAP means generally accepted accounting practice. Normal loss, abnormal loss. Acha, if there's a normal loss, do you show it separately as an expense in the P&L? No. But what about abnormal loss? Yes, if there's an abnormal loss as per GAAP. GAAP is generally accepted accounting practices. The generally accepted accounting practice is that if the loss is a normal loss, it should it should be a part of the cost of the asset. But if it's an abnormal loss, it should go to the P&L account. For example, let us say you are constructing a 10-kilometer highway stretch on, let us say, the Andheri to Borivali route in Mumbai. Now, in that, I think that for 1 kilometer of stretch, I believe that the cost would be 1 crore. It's a 10-kilometer stretch, so 10 crore mein ban jana chahiye. Do I expect any wastage loss over there? No. So I believe 10 crore is my cost. However, that same 10-kilometer stretch, I am responsible to construct, for example, on the Manali-Leh highway. If you have seen, that's a very treacherous route with a lot of landslides and everything happening. Now, I believe that construction cost is 1 crore plus per kilometer. But here, यहाँ पे तो आए दिन landslide होता रहता. So I believe 50% तो ऐसे ही बढ़ जाएगा cost because of landslide. Here, landslide does not happen. In general, it does not happen. हुआ था अभी बीच में. But in general, it does not happen. So over here, if the landslide happens on the Bombay route, we say, yeah, that is a loss. It should go to the P&L account. We never factored it on the construction. But on the Manali-Leh patch, we will say कि भाई मेरा asset ही 15 crore का बनेगा. My construction cost may be 1 crore per kilometer, but I believe कि 5 crore तो ऐसे ही loss होएगा. That is a loss which is expected in the ordinary course. That is called as a normal loss. And hence, if such a normal loss happens because of the landslide, I will still capitalize it along with the PP. But here, if a loss happens, I will take it to P&L. यहाँ पे मेरा road बनेगा 10 crore का ही, 10 crore का road, 5 crore goes to P&L if there was a loss. There, my road will be 10 plus 5, 15 crores. Did you understand? What is the principle? Normal loss is capitalized along with cost. Abnormal loss goes to the profit and loss account, not just over here, in inventory, in your costing, everywhere. Normal loss is capitalized, abnormal loss goes to the P&L. Are we clear with this? Sure, any problems? No? Okay. Now, it's a very important discussion, so I want your undivided attention. I know it's a little difficult at this point, but it's a very important discussion. So we'll probably have you heard about site restoration earlier? Have you done it at CA Inter?
Yes.
I think 5-6 people have. But ऐसा सुना है कि नहीं सुना है अपन? अच्छा, what do you mean by site restoration expense? So over here, let's try it. I mean, it's very important. It is this one of those things which has implication in multiple standards. So it's a good thought to spend your Sunday afternoon on. Okay, so let's first try to understand what site restoration means and how it should be accounted. There are two standards at play over here. One is Ind AS 16, property, plant and equipment, and one is Ind AS 37, provisions and contingencies, equivalent to your AS 29. अगले जो AS 29 हुआ करता था. अच्छा, let us say you are planning of setting up a factory site in one of the two locations. One is site A, one is site B. Let us say the construction cost that you will have to incur today at year 0 is 90 rupees for site A, is 100 rupees for site B. All else remaining equal. Which of the two is the more costly site? What time लगा अपने को सोचने को? Which of the two is more costly? Site B. Site B is more costly because the construction cost is greater. अच्छा, now site B is in a very remote location. Site A is near to a settlement. So the government says, let's say you are setting up a nuclear power plant. You are setting up a nuclear power plant. So government says कि यार site B तो desert के बीच में, तो it's fine. After 5-10 years when you use this site, even if you abandon it, it's fine, no one is coming here. But site A is very close to people staying. So the legal requirement states that you will have to dismantle site A at the end of the useful life, decommission, dismantle, and restore the site in the condition it was when you took it. So you want to construct, so that is called a site restoration obligation. Site B is in a very remote location, so it is costly to build. But then at the end of 10 years, let us say the life is 10 years, I don't have any obligation, I can just abandon it and move out. But site I can't just abandon. At the end of 10 years, I am bound by a government agreement that I will have to dismantle this site. Kabhi karenge? Year 10 pe, year 0 pe? Year 10. I'll have to dismantle it and restore the site in the condition it was when I took it. Will that dismantling cost me something? Yes. So let us say I am expecting the dismantling cost to be 50 rupees. Acha, what about site B? Will there be any dismantling cost? No. Acha, when is this cost going to be incurred? Year 10. Now, as per generally accepted accounting practices, your journal entry would be, we would say कि यार sitting today when we are in year 0, let us say I am doing the accounting for site A. My journal entry will be PP account debit 90 to bank 90. अरे बराबर क्या नहीं? What about this 50 rupees? देखा जाएगा attitude. We will say that okay, when it comes after 10 years, that is when I will record it. Is that correct? Why no? Why provision? No. पहले why provision? Okay. See, let us say I am expecting that in the next year you will earn 200 rupees of income. Next year you will earn 200 rupees of income. Do you record a provision for tax now? When do you record provision for tax? When you earn the income. So ideally, when should you create a provision? You should create a provision when the obligating event arises. When the obligation arises. And when does the obligation to pay tax arise? Well, when you earn the income. But when does the obligation to dismantle arise? The moment you construct. You might discharge the obligation after 10 years. But even if you decide very next second कि भाई मेरे को continue नहीं करने का, you will have to dismantle. You can't just abandon for 10 years. You will have to, the obligation arises the moment you construct. The obligation is discharged when you actually dismantle. But it arises when you construct. How do you define an obligation? Something for which you have no alternative but to settle. Income tax, if you don't earn profits, you will not pay tax. यहाँ पे ऐसा नहीं है बॉस, आपने कंस्ट्रक्ट करके रख दिया है. You have no obligation but to dismantle. Students always say, sir, we are doing it at 10 years. You are not doing cash system of accounting. You are doing accrual system of accounting. Accrual does not happen after 10 years. Acha, just to kind of draw a parallel, in your CA Inter, have you created a provision for warranty ever? AS29 में आपने create किया नहीं किया? छोड़ देते चलो, forget it. So there's no parallel then. So usually warranty में लोग ऐसे करते, you make a sale now. You create a provision for warranty now, but warranty तो future में जाने वाला है. अरे but obligation arises the moment you make the sale. You have no alternative but to repair when they come to you. That is the logic. So, but forget that. So over here we'll focus on dismantling only. So when we're looking at dismantling, the thought should be, when does the obligation arise? The obligation arise. What is obligation? You have no realistic alternative but to settle. The moment you construct, you are under an obligation to dismantle. Yes, you may not dismantle now, but वैसे तो when you take a loan, you are under an obligation to repay. You don't have to repay now, but you have to repay. So you create a loan liability. अरे repay तो 10 साल बाद करना, हाँ, but you have an obligation to repay, and hence you show it as a liability. So remember, you will have to create a provision for site restoration, at least in this example. It is not necessary that every time you create a provision for site restoration. For example, if let us say you are drilling an oil well ड्रिलिंग में कुछ भी नहीं होता. You have set up the oil well. You don't have any dismantling obligation. But the moment you start exploring, it will create a lot of dirt. Every year that you explore, the dirt keeps on piling up. You are an obligation to clean up that dirt. What is the obligating event? Is it constructing the oil rig? No. Then on construction of oil rig, you will say, "Bhai, abhi tak I don't have any cleanup obligation." The moment each year you mine out, dirt arises. Obligation to clean. You have signed. Another year, obligation builds up when the dirt arises, not when you have constructed. यहाँ पे वैसा नहीं है. यहाँ पे the obligation arises the moment you construct. Are we able to distinguish? Obligating event is the event when the construction has happened, and hence, as per AS 29 or Ind AS 37, provisions and contingencies, you will have to create a provision. Are you understanding the accounting rationale? If not, just remember you have to create a provision. Right? Okay. So you will have to create a provision, but when you create a provision, you have to do double entry. So if you credit the provision, something has to be debited. So otherwise, Ind AS 37 case, provision is getting created. So over here we are saying, okay, PP account debit to bank 90, but we are saying no, we will also have to credit a provision. Provision for what? I am writing it in short. Provision for SRO. What is SRO? Site restoration obligation. We will create it at 50 rupees. Yes or no? No. Why no? Perfect. Expense incurred after 10 years is not equivalent to expense incurred today. So to say that chalo we create a provision at 50 rupees is not correct. So what will you have to do? You will have to find the present value factor, for which usually a discounting factor will be given to you. In practice, a discounting factor is similar to kind of the cost of capital, like the WSCC. There are various thought process, but for the timing, let us say we focus more on the discounting factor, let us say being at 10%. The discounting factor, let us say being at 10%. So, and what is the life of this? The life over here, for example, is also 10 years. So, we will say that where 50 rupees to be incurred after 10 years is not equivalent to 50 rupees incurred today. But I am passing this entry at year 0. If I am passing this entry at year 0, I can't book it at 50 rupees. I am ignoring time value of money. Should I consider time value of money? Yes. And hence you would record it at 50 into the present value factor at the rate of 10% for the 10th year. This is how do you calculate this? 1 divided by 1.1 equals to you do this how many times? इसमें अपने चैम्प पे. So over here, how much should you get ideally? 0.3855 approximately. If I multiply this, 50 into 0.3855, 19.28 approximately. What does this number mean? It means that if someone tells me to spend 50 rupees after 10 years, or someone tells me to spend an X amount today, I would be indifferent. Time value of money. So I will be indifferent spending 19.28 today or spending 50 rupees after 10 years. It is the same thing for me. That is what time value of money is. Are you yes or no? Yes. Achha, now provision is credited. What will be debited? You have 2-3 options. You debit the PP. You debit the PNL. What do you debit? Why? Otherwise, abhi kyun padte? Right? Why would we study it now if it was not for PP? Why should we debit the PP? Why not PNL? It seems to be an expense. Why not the PNL? Okay, let's put it the other way around. Ideally, it should go to the PNL. Kharcha hai. Why should it not go to the PNL account? It's an expense. It is directly attributable. Okay. So, okay, it is directly attributable to the acquisition of PP. It's a cost which is attributable. If I don't do that, what will happen is, if I were to do comparability, there will be one company which took site A, there will be one company which took site B. If I look at my site let's say I have taken side B, so I have shown my PP at 100 because side B में तो site restoration है ही नहीं. My shareholders will open my competitor's balance sheet and they will say यार तुम क्या कर रहे हो? You are setting up a plant at the corner of the earth and spending 100 rupees, and rather look at your competitor is setting it in a prime location and spending only 90. Are you actually spending only 90 for the plant? No, 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 the real cost is much more. To say that 90 is the cost of the plant is wrong. 90 is the immediate cost of the plant. The total amount that you are paying for the plant is 90 today, 50 after 10 years. So to say that plant सिर्फ 90 में आ गया, no, 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 plant is not coming for 90 rupees. Plant is coming at 90 today plus 50. You have no choice but to pay both of them. And hence, to compare these two and say, chalo na, let it go to P&L. If you let it go to P&L, comparability will be distorted. Company A will say that my asset is worth 90 only. Company B will say my asset is 100. Shareholders will say, this is a better asset. No, it is not a better asset. It's a more costly asset. Dikh raha nahi hai. Financial reporting. You have to report in a way that gives the right picture. The right cost of the asset is not just 90. 90 is a part that you are paying today, but you have an unavoidable obligation to pay 50 after 5 years. Again, in your mind, a query will almost always come, and I hope it has come, that how did we decide 50? It's an accounting estimate, can keep on changing. How will we change? We will see that. It's the important part, but let us assume the estimate does not change. But kharcha to karna hi hai na yaar. You have no choice but to spend that 50 rupees. Are we clear with this? So what are we debiting here? We are debiting PPE by, for example, 19 point. Therefore, your total PP to be recorded for site A will be 90 plus 19.28, that comes to 109.28. And if I now compare this with site B, my shareholders will understand, okay, I've gone to a remote location because it is relatively cheaper for me. It is not 90 versus 100, it is 109 versus 100, and hence that will give me a better perspective. Are we clear with this? So present value of site restoration. Present value of site restoration should be capitalized along with PP, and second effect will go to the provisions. Are we clear with this? Acha, this is initial accounting. What will happen subsequently in each of the years? What will happen to the PP in each of the years? Will this continue to remain at 109.28? No, what will happen? Depreciation. 10.928 per annum. From year 1 to year 10, you will keep on depreciating the PP. Depreciation account debit to PP, depreciation account debit to nuclear plant, depreciation account debit to nuclear plant. Karte, it will reach to 0 after 10 years. नहीं अपन वही कर रहे हैं. We are just reaching there. So over here, your PP comes from 109.28 all the way down to 0. What do you think will happen with the provision? Provision also will go from 19.28 ultimately after 10 years to 0 rupees. Acha, you have three options. Provision continues at 19.28 for all the 10 years. Provision goes from 19.28 to 0 rupees like PP does after 10 years, or provision goes from 19.28 to 50 rupees. 50. And as a result, there has to be like depreciation brings the PP down to 0. Sir, why 0? Arey, that is salvage value. Ultimately, PP कुछ भी नहीं देने वाला है. So I have to bring the 109 down to 0 rupees. But provision will make me spend an X amount. Sir, कितना amount? 19? No. It will make me spend 50 rupees after 10 years. So my accounting should be done ideally in such a way that the 19.28 slowly reaches up to 50. Now how will that reach up to 50? How will that reach up to 50? Acha. So first let's kind of deconstruct the journal entry. What will happen? In year 1, depreciation etc. is done. Do I need to increase the provision or do I need to decrease the provision? So will I credit the provision or debit it? Credit. So I will credit the provision. Now by how much will I credit? Then we'll decide what to debit, but by how much will I credit? The simplistic approach, the overly simplistic approach would be that you do 50 minus 19.28, जो भी आता है divided by 10. That is like simple interest, समझते हैं. But Is simple interest appropriate? Why no? Discounting is not by simple interest. You know how is a discount factor derived? In your FM, compound interest formula is A is equal to P into 1 plus R raised to N. Compound interest formula. When I want P is the present value, I do A upon 1 plus R raised to N. This gives me P. Therefore, A, that is the future value, into 1 by 1 plus R raised to N is equal to B. और ये number को आप बोलते हो discount factor. Discount factor is the inverse of the compounding factor. It is not simple interest factor. It is compounding factor. तो to say कि भाई ठीक है, when the journey from 50 to 19 was done, I use compounding. I mean the inverse of compounding, that is discounting. So if the journey from 19 to 50 is to be done, shouldn't I also use the same compounding principles? Technically, if you do on your calculators, just for your understanding, 19.28 into 1 plus 0.1 raised to 10. आपको समझा मैंने क्या किया? If I do 1.1, 2, 3, 4, 5, 6, 7, 8, 9, 10. If I do 19.28 into क्या आ रहा है आपके कैलकुलेटर पे? 2.5937 approximately. If I multiply this, there you go. I see exactly 50. So the way to reach from 50 to 19 and the way to reach from 19 to 50 has to be the same. अच्छा अपन मुंडी हिला रहे. What do you understand? What will we do? If I want to find the amount in the first year, what should I do? मेरे को नंबर बोलो. 19.28 into, let us say 10%. I mean 1.1 will give you the provision value. 1.1 will give you what the closing provision should be, but entry has to be for the difference amount only. So into 0.1 or 10%, into 0.1 or 10% if you do, this is 19.28, 1.928 or 1.93 let us say. Acha, if I want to go into the next year, again 19.28 into 10%. No, compounding will teach me that it is not 19.28 each year. It will be, तभी तो 50 पे पहुंचेगा ना. So what I will do is, if I look at the provision account, in my provision account there will be year 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You will have an opening provision of 19.28. 10% of that is around 1.93. Is anything paid during the year? Is anything paid during the year? No. So your closing provision would be what? 19.28 plus 1.93, 21 point. Acha, for the next year, 21.21 into 10%, 2.12. And so on so forth. Tell me, if you keep on doing this, at the end you should land up where? 50. You should actually land up and you will land up at 50. Are we clear with this? समझ में आ रहा? अच्छा, it's a little intense. I mean, if you are not able to catch it right now, you will have to go through it, but you will understand, and you should not skip this. From today's class, this is the most important aspect, the most, without doubt. So this is provision credit. What will you debit? Again, you have 2-3 options. You have to debit PP, or you debit the PNL. If you debit the PNL under what heading is secondary, but should you debit the PP or should you debit the PNL? Sorry, how many think it should be PP? अभी अपना हाथ नीचे ऐसा, why should it be PP? That's fine. अच्छा, how many think it should be PNL? Why PNL? PP तो is in any case will become 0 whether you take. Sorry. Okay. Let me just draw a parallel to this. Okay. Let us say I did not have money. Let us say I did not have money, and I took a loan to buy the asset. I took a loan of 19.28 rupees. I did not have enough money. I had to pay 50 rupees or something. I used that 19.28 to buy the asset. Forget this case. I wanted to buy the asset. Asset 19.28 का ही था. There is no site restoration obligation. I took a loan of 19.28. I bought the asset worth 19.28. There's no site restoration obligation. Ultimately, the loan has to be repaid. After 10 years, I have to pay 50 rupees. Interest karte karte. PP 19.28 से 0 पे it will come. Each year, I ultimately have to pay 50 rupees. That additional element, 19.28 का loan I took, 50 I repaid. Will that difference of 30 over the period of 10 years be added to my PP in general? No site restoration. Will it be added? Why are you saying no? आप बराबर बोल रहे हो, but why? It is interest in nature, and interest is not added. It is due to passage of time. 19.28 today is 50 after 10 years. The difference between 19 and 50 is due to passage of time, and any cost which is due to passage of time is called as interest, and interest cannot go into the assets cost unless it's a qualifying asset. मैंने बहुत कुछ बोल दिया. But over here, see what happens is the gap. See, 19 is like the money that you need for the asset, for the expenditure. But if someone told you कि एक काम करो, if the government told you एक काम करो, you have to dismantle, but I don't trust you. You deposit 19.28 today with me because 50 rupees has to be spent. So you are depositing 19.28 towards the asset. उसमें time it is towards the asset, towards the cost for the asset. Now ultimately after 10 years, government on your behalf will dismantle, but government will spend 50 rupees. So the additional that it is spending is because the money spent after 10 years. If hypothetically the dismantling happened today only, I will not need to spend 50 rupees. So that additional element of 30 is not attributable to the asset, it is attributable to time. And any cost which is attributable to time, that is finance cost, is not added into the cost of the asset. Had I taken a pure loan and paid interest on that pure loan, that interest never goes into the cost of the asset, because abhi the nuclear plant is ready for use. That will not go into the cost of the asset. So if that is not going into the cost of the asset, even this difference should not go into the cost of the asset. And standard does not allow you to take, because this is linked to the passage of time. Sir, what do you call this? This is called as unwinding cost. You open balance sheets of companies like ONGC. They have big oil rigs, you will see huge unwinding cost over there. You will see site restoration obligations of ONGC, oil and gas companies. And you will see in their finance cost an unwinding of discount, करके एक adjustment being given, big amounts. Because it is not linked to getting the oil rig in the ready to use condition. अगर मेरे को आज का आज dismantle करना होता, I would have paid 19.28, end of story. Sir, but you are paying 50. That means that additional amount, well, that is not linked to asset being costly. That is linked to you getting 10 years to pay that amount. समझना मुश्किल है. I'll just give you another parallel. Let us say there was a vendor financing arrangement. Vendor financing समझ रहे? You are Tata Airlines. You are buying aircraft from Boeing. Boeing tells you that if you want to buy the aircraft now, you pay me 19.28 now. Or if you want to buy the aircrafts now and you need a time, then you pay me 50 rupees after 10 years. Can I say the aircraft costed me 50 rupees if I take a 10-year time? No, the aircraft still costed me 19 rupees. No, sir, but you are paying 50. Additional 30 you are not paying for the aircraft. The additional 30 you are paying because you got 10 years to pay. So that additional 30 is linked to the passage of time. To capitalize it along with the aircraft is wrong. Are we able to draw a parallel? So this is exactly similar to that. Like if Boeing had told you to pay the money now, I would have paid 19.28 now and the aircraft costed me 19.28. Boeing said, well, you know what, I'll give you 10 years, you take the aircraft now, use it for 10 years, you pay me. In C-Inter, I don't know, आपके syllabus में some of you might have done hire purchase, सुना है अपन? Hire purchase में same गणित होता था. You pay now or you pay later, the difference over there is linked to passage of time. You don't keep on adding the truck and tractor account because of that. That additional amount cannot be added to the PP. Do you understand the logic for that? Yes? Okay, so we should not touch the PP. So where will it go? PNL. Yeah, but PNL mein where will it go? Other expenses, employee benefit expenses, cost of material, depreciation, amortization, finance cost. There are so many headings in PNL. Finance cost. Why finance cost? It is linked to passage of time. The difference between the two is only and only because you are getting 10 years. So sir, what do you call this? We call it as unwinding of discount, which is similar to interest but not exactly interest, because there is actually no real loan. There is no real loan. It is similar to a loan where you are taking a 10-year time, but it's not a real actual loan, but it is clubbed along with finance cost. Are we clear with this? Thak gaye apan? Right? Okay. So over here, your journal entry would be finance cost, account debit. This will go to the P&L 1.93. At this stage, even if you understand this much, more than enough. Once you do a lot of sums, that is when we will go to a case where what will happen if the estimate changes. Yeah, we thought 50, few years later we think abhi 60 lagega, 40 lag sakta hai. Then what will we do? Are we clear with this? So if I were to build this table, 23.33, this is 2.33, 23.33 plus 2.33 comes to what? 25.66. 25.66, 10% is 2.57, comes to, ऐसा लग रहा है मेरे को ही सीए करने का वापस. अरे आप करो कैलकुलेट. So over here you'll have 28.23 and 2.82, 31.05, 31.05, 3.11, 16, 34.16, 3.42, 5, 8, 37.58 and 3.76, 41.33 और 34, चलो 34, 4.13, 45. And if you look at 45.47 plus 4. Let us say 53, if you want to exactly, I mean rounding off, there will be some difference. So this is 50. Why did we do this journey of the entire 10 years? Because we want to see how the double entry works. What happened at year 0, you pass the entry. If I pass the combined entry, PP account debit 109.28, to bank 90, to provision for site restoration 19.28. Are we clear with this? Then from year 1 to year 10, you pass the entry depreciation account debit to PP. So ultimately your PP turned down to a zero value, 10.928, 10.928, PP came down to zero value. Then from year 1 to year 10, you also pass the entry finance cost, because it is linked to passage of time, to provision for site restoration. Now this is different amounts each year, but if I total this up, can you tell me without totaling, ideally what should this number look at? The difference between these two. It is due to passage of time. If you want, you can total it, but your answer should ideally be 30.72. You can see that. So over the years, it is not over a single year, but over the years, this is 30.72. 30.72. This is over 10 years. Now what will happen at the end of year 10, your PP has come down to a nil balance. Your provision has climbed all the way up to a 50 balance. And if your estimates prove out to be correct, and we'll see if they are not, but if they prove out to be correct, what will be your entry? Provision account debit 50 to bank 50. Earlier, before this treatment came, what was your entry? P&L account debit, because 10 साल बाद तो PP would have become zero. P&L account debit 50 to bank 50. We said why? 10वें साल के P&L को क्यों इतना bear करना है? That is not attributable just to the 10th year. It is attributable to the asset and the passage of time over 10 years. Out of the 50 rupees, 19 is attributable towards the asset, 30 is attributable to the 10 years. And as a result, when you come to the 10th year, there is no additional cost to book. It is provision account debit to bank because that, so that 50 is booked, yes. How is that 50 booked? Well, 30 is booked in the form of finance cost. Remaining 19 has gone to the PP and through depreciation, it got transferred to P&L. Otherwise, for depreciation would have been 9 rupees only. 9 समझा कहाँ से? 90 divided by 10 would have been 9 only. Now because of this, आपका depreciation भी बढ़ गया. So ultimately 50 went to the P&L. But matching in the sense it went not at the 10th year. It went over the 10 years. Are we clear with this? Yes. Okay. So any problems here, please? Unwinding of discount. It is called as unwinding of discount. It's not that you have to use the exact same words. Different clients, different companies you might see use different words, but the essence has to be the same. Any problems here? Yes, please.
So as you said, the first 19.28 goes to the P&L via depreciation. So the remaining 31 rupees, how does it go to the P&L via?
Finance cost.
We didn't pass the entry for P&L.
Finance cost is a nominal account.
Okay.
That nominal account will be transferred to the P&L. Depreciation is a nominal account, it will be transferred to the P&L. P&L to finance cost. Are we clear with this? Any other problems? कुछ पूछने के लायक ही नहीं बच्चा समझ में आया कि नहीं बट राइट ओके सो इट्स अ वेरी इंपॉर्टेंट कॉन्सेप्ट इट हैज whichever concept, not just this, has more than one standard applicable. Institute loves asking that. Wherever there are multiple things you can test in one, like in this you can test the application of 2 standards. So Institute will love usually asking you. Many sums have come on the application of site restoration concept. Okay, note 2, very important. Sorry, वो दिख रहा नहीं क्या? हाँ, notes है ये. No, so this board notes, if you were slightly awake before the lecture, we said that board notes will share separately, so you can sit back and relax if you want. But otherwise, every day will, there will be a drive link, and on the drive link you will have the notes for each day being uploaded. Yes. So where you can see your backup lectures, udhar hi. This will be open unencrypted files, so you can review the board notes from there. But it is always a good practice to also write with your own hands, so you kind of develop a slightly better understanding also. आपको डे वाइज ही मिलेगा अभी तो. You will get day wise. Later तो it will be compiled in the entire single. मेरे को सिर्फ आपका एग्जाम ही लिखना बाकी है. I just have to do that only now. Okay. So let us review this. Provision for decommissioning, site restoration, dismantling. Okay, I'll just do that. Just a minute. Okay, these are legal or constructive obligations. What do you mean by legal obligations? They arise out of law or they arise out of contract. Like the government law might say that you have to dismantle in certain business. It's a legal obligation. Or the law might not be clear, but the contract between the parties is clear. In that contract, how do you define a contract? Contract is enforceable by law. These are legal obligations or constructive obligations. The word constructive is new. It comes across all indices, almost all. We'll understand what it means. To restore the site back to its original condition at the end of the project life. These are dismantling obligations. As per 16, the present value of these costs should be capitalized. In our example, 19 rupees. Example, the initial cost is 90. Here the estimated site restoration is 40. So you have a slightly different number base as compared to the example. The discount factor is at the rate of 10%. Life is 10 years. So a journal entry is PP account debit. In this case at 105. So basically this is 90 plus 15.4. Double entry. Your PP is added by 15 as compared to 19. So 90 plus 15 comes to, in our example it was 19.28, but that was because we estimated 50. यहाँ पे 40 rupees का estimate. At year 1, depreciation account debit to PP, that's fine. And then finance cost, this is the important one. Account debit to provision. What is 1.54? Well, 1.54 is attributable to the passage of time, and hence should be recorded as finance cost in the profit and loss account, and you have been given the finance cost. It's better if you refer the board note for understanding the entire journey of this. In the last year, if you go to see if you have done your workings properly, the provision slowly comes up to the amount that you expect to be paid. And when you actually write the check to pay that 50 rupees, to bank will be 50. Something has to be debited. Well, PP is already 0. Provision is there, so you negate the provision account debit to bank, and hence the entry will be provision account debit to bank. So your provision is 0, PP is 0, expense has been evenly spread out. Okay, now what do you mean by constructive? And constructive is, the word constructive comes at many places. Ind AS 16, Ind AS 37, Ind AS 19, 109, many places. AS and Ind AS. AS is a more legal framework, Ind AS is more of a principle based framework. What do you mean by constructive obligations? The word constructive means not just over here, this is across the board. Let me take another example. Let us say you are looking at salaries. Let us say there is a house help that comes to your house and you pay them, for example, 100 rupees. So over here 100 rupees, if you don't pay them, can they sue you? It's a oral ho ya written ho, it's a contract enforceable by law. And hence if they worked for a month, you don't pay them, they can sue you. There's a legal obligation to pay 100. However, let us say there's an unsaid rule between the two of you that every Diwali you give 1 month bonus. But is that an agreement that I will give you 1 month bonus? That is past practice, which creates expectation in the minds of the affected parties. I'll again repeat, it's a past practice. Last 20 years you've always given 1 month, half month, jo bhi hai, of salary as Diwali bonus. This gives rise to what we call as a constructive obligation, because as per past practice, that gives rise to expectation in the minds of the employee. Now if you don't pay the Diwali bonus, can they sue you? They can't sue you. In general, they can't sue you. I mean, 2-4 गाली सुनना पड़ेगा. Maybe they can leave a job, but they can't sue you for that because it's not a legal obligation. Now, AS would have said, let us say hypothetically, Diwali comes, let us say in November, and your year ending was 30th November. AS would have said that if you have not paid Diwali bonus, there's no obligation. AS says they can't sue you. If they can't sue you, I mean, in general you have been paying, that's fine, but there's no obligation. It is avoidable in nature. You don't have to necessarily pay. If you don't want to pay, you don't pay. Yeah, but आपका intention है pay करने का. But AS says no, it's not a legal obligation. You record it as and when you pay it. Ind AS says no. Ind AS says substance over legal form. सुना अपन? We say in substance, if in the past we have always paid, if we intend to pay, even in this year, we are on 30th November, we have not yet paid, probably employee has gone out, maybe something, we have not yet paid. Ind AS says, we should create a provision. Sir, but how will you create it? It's not a legal obligation. Haan, but it is a constructive one. Across the board, Ind AS 37, Ind AS 19, everywhere, the standard puts legal and constructive at the same level. It says ke bhai theek hai yaar, in the context of site restoration, if you are a very environmentally conscious company, everywhere you have gone, the last 50 projects you have done, you have always dismantled, whether there was an obligation or not. Even this project you have taken, there's no legal obligation for you to dismantle, but as per your past practices, as per your policies, you will always dismantle, clean up the place and then leave. There's no legal obligation on you. But constructively, in essence, if the management believes and its past practice support that, then why not create the provision? So Ind AS will tell you कि आपको provision बनाना है for both legal as well as constructive obligations, not just over here. Even Diwali bonus for employees, you create a provision. So 30th November we have not paid it. What is the obligating event? Diwali. If Diwali has gone by, you create a provision if it is not yet paid. No sir, it is not legally obligation. That's fine. It's a constructive obligation. So there's an RTP question which had come on site restoration where they had told you that there is no legal obligation to restore, but there's a constructive obligation. We have to remember that Ind AS, which is different from AS, will treat both legal and constructive at the same level. अगर ये सेम AS का क्वेश्चन, you don't create a provision for constructive obligation. Index question, you create a provision even for constructive obligation. Sir, can it be open to manipulation? Definitely. But as a student, we are assuming good faith accounting, and as a result, we don't go into the tangent. But otherwise, yes, it is subjective, highly open to interpretation. Do we understand what constructive means? What is constructive obligation? Another example would be like when you buy shoes from Nike, Adidas, Reebok, etc. You do get a warranty card. That's a legal obligation. If your shoes develop a problem, you give the shoes, they are under legal obligation to repair. You buy shoes from a local vendor. He has not given you a warranty card, but the shop has a very good reputation. Whenever any faults have come in the next 6 months, you have gone, they've repaired it free of cost. Always. If I'm in the books of the shopkeeper, I have a constructive warranty obligation. I don't have a legal one. No one can sue me. But my past practices showcase that I've always repaired it. So even if I have no legal obligation to repair, and if I intend in good faith to continue repairing, then why should I not create a provision? Shant says substance over legal form. In substance you are going to repair. In substance you are going to give Diwali bonus. In substance you are going to restore. Then why not follow the same accounting treatment? And hence आपको ये याद रखना that when you do site restoration, you will calculate. Okay, when we do site restoration, you will calculate the legal as well as constructive obligation. Yes, please. Can be, but you should follow that. It is not so. Like for example, in your context, almost all CA firms give you a particular benefit. They give, let's say, something for Diwali. Your firm has never given it. So अपने को ऐसा नहीं बोल सकते we can create a provision, right? So that means block leave मिलता है काफी जगह पे. अपने को block leave नहीं, leave भी नहीं मिलता, right? Okay, so that ways it has to be based on industry practice, clubbed with your expectation of how you discharge that. Are you clear with this? Okay, so I'll just quickly recap this and then we can stop for the day. So when we look at site restoration calculation, first of all you will estimate, it's an accounting estimate, the site restoration amount. Once you estimate that, you will try to find the present value because restoration is going to happen in the future. When you try to find the present value, you will take an appropriate discount rate depending on the risk of the asset. But again, you are doing accounting, so discount rate is given, but otherwise it is depending on the risk of the asset. If your nuclear plant in general has a 12% cost of capital, your other projects have a lower cost of capital. It depends on the risk of the asset. So you find an appropriate discount rate, which will 99% be given in the question only. You're doing an FR paper, not an AFM one. So you will be given the discount factor. You try to find it at present value. So 50 rupees that you are going to pay 10 years later is equivalent to how much today? That value that you are going to consider will be a part of the provision. Sir, why should you create a provision? Because obligation arises. When does the obligation arise? The moment you construct. And second effect of that will go to the PP. Why? Because it makes the PP more costly. The true cost of the PP is not just 90. It is 90 now plus 50 after 10 years, which is equal to 19.28 now. That is the true cost. Once you do that, PP gets depreciated in the usual manner, but the provision has to go up to what you expect. Why should the provision change? Well, once you determine 19.28, each year you will record what we call as finance cost at the rate of 10%. Opening into 10%. So 19.28 into 10%, that's 1.93, and 19.28 plus 1.93 will give you 21.21. 21.21 plus this is nothing but 21.21 into 10%, and that will give you 23.33, and so on and so forth. Ideally you will land up to 50 rupees, which you will ultimately discharge. Are we clear with this? Chalo, I think we have had enough of battering for today. So we'll continue tomorrow. Please do revise whatever has been done on a daily basis. It will really help you be on speed. Ensure that you spend, typically what I would strongly recommend is, if possible you revise whatever is done on a daily basis, spend a few minutes. but at least by the end of the week, abhi to we are at the end of the week, but by the end of the week you spend probably 2 to 3 hours and run through whatever has been done. The moment a chapter is over, revise that chapter, it is very fresh, then do the MCQs, because then you will know where you stand, and then you will slowly reach up to the place where you do a proper revision before the monthly test. ठीक है, चलो, thank you very much, we'll stop.